The Fed's aggressive rate hikes have claimed the first major victim.
What is going on then at SVB?
With this collapse of SVB,
the biggest bank failure since the 2008 financial crisis is sending chills through markets. And regulators from the US and Europe are rushing to prevent contagion. Meanwhile, the ongoing war in Ukraine is upending the already fragile recovery. With the days of easy money over, where do opportunities lie? Is a recession unavoidable? Is a traditional 60-40 portfolio dead? How can investors navigate geopolitical turbulence and economic uncertainty? We put these questions to the biggest names across finance and economics. This is Bloomberg Invest, Strategies for Wealth Creation. Good morning, everyone, and welcome to Bloomberg Invest Strategies for Wealth Creation. Now, whether you're joining us virtually or you're here with us in the room, thank you so much for being with us today. I hope you had a chance to get a coffee. So I hope everyone's fully hydrated and fully caffeinated and that you're ready for the day ahead. So what is wealth? The definition has changed over time, as many of you know, as we have tools that we created it with have also changed. As the world continues today to grapple with geopolitical tensions, increased market volatility, especially in the last 3 weeks, and a high inflation, today we ask, how should we put our money to work? And where should we put it? The conversation is all the more important and timely as we keep a very close eye on the turmoil in the financial and banking sector. We have an incredible lineup of speakers this afternoon and this morning. We'll have also a special recording of the popular podcast, Marin Talks Money. I assure you this is going to be a fun one, hosted by Marin Somerset Webb of Bloomberg Opinion. So we want you to be part of the conversation today. We'll be polling. Here's how it works. Please scan the QR code on the screen right here behind me. You can respond to polls or also send in a question for our moderators. Please do send them in and we'll make sure to ask those questions to our guests. So let's practice that. This is the hardest question you're going to have all day. Get your phones out. This is like CFA level 4. All right, the question is, if I won the lottery, all right, today I would A, keep the cash, 2, invest it, C, donate the money, D, travel and shop. We should have like, you know, what would you be buying? You can, no, only one, I think. Don't cheat. All right, so as it settles, I mean, this is actually quite hard. This is like, you know, do I buy AT1s in banks or not? So it just takes a couple of seconds to settle, and we have invested. All right, we have a serious crowd. Not many people saying, I'm going to shop until I drop and travel. So look out for results on the poll. You can see them here, but I think you can also see it on your screen. Please also see a Bloomberg representative just outside this room or scan QR codes if you're interested in a complimentary subscription to Bloomberg. One final point, please also do engage with us on social media. We're active there, and the hashtag is Bloomberg Invest. Thank you for joining us. What a week it's been. I know a lot of you have had a pretty hectic, maybe traumatizing week. 15 years of the global financial crisis, and we witnessed over the weekend the downfall of one of Switzerland's largest banks. Now, Bloomberg journalists, as you know, have followed the twists and turns of the story with smart analysis and smart insights, and I'd like to welcome to the stage our host for today and our editor-in-chief, John Micklethwaite, to discuss the latest crisis in the banking sector. So, John, thank you so much. John, you wrote a really smart piece, and I'm not just saying that because you're my boss and could fire me at any moment, but you wrote a brilliant piece with Adrian Woolridge on the banking sector. And it's a piece that I haven't really read before because it looks back almost to the history of banking and how it's going to be changed going forward because of what we lived through in the last 3 weeks. You talk about this, you were in Scotland, and you talk about this like wall of misery or mystery.
Yeah, I was up in Scotland actually with Merrin Somerset Webb, who you'll hear later, who's much better at wealth creation than I am. But if you go to Edinburgh, hidden away in the financial district, there is a place called the Library of Mistakes. And it's a completely amazing museum set up by, it focuses on financial mistakes. And you can see in one corner a shirt signed by Nick Leeson, who actually today we have a story saying has just taken up a job as a kind of private spook. And on the other hand, there's a picture of Charles Ponzi, and the walls groan with books about financial disaster. I think one of them written by me, but most of them much better, with titles like, you know, where are all the customers' yachts? And what's interesting about you sit there is it's not a bad place to think that one of the themes of the museum is that in things like technology and engineering, progress is linear. In finance, it's cyclical. And even if you're me, I think I started, the first big story I ever covered was the 1987 crash. You just see the same themes coming back every single time. You see financiers running off who previously loved the free market, except when it happens to them. You see regulators tending to fight the previous war. You see people who condemn capitalism suddenly claiming that it's all come to bits. And each time you always end up with new rules. And this time our guess is that there will be some new rules, I think. There will obviously change things like the level at which they study banks in America. If you think Silicon Valley Bank had $200 billion of assets, which by most people's definition is the sort of bank you should be looking at. America only rather sort of strangely chose to look at ones above 250 billion, which are enormous. And so you had these problems endemic. There will be some things they fiddle with that. But the main thing we think is that what's happened is this crisis has just come at a time when mercantilism is on the rise. And I think that what will happen is that governments who already think about technology as a core industry are going to start seeing finance much more so.
What have we lived through in the last 3 weeks, actually? Is it a bank run because of liquidity? Is it panic in the markets, or something more underlying?
I think it's really liquidity. If you look at the capital ratio, if you look at the big things that went wrong last time, you look at the last crisis, basically it was all about asset quality and stuff. You had enormous amounts of slightly dodgy debt, all those derivatives, all that subprime loans, piled up on very small slithers of capital. What's happened since then is the central banks, regulators have pushed people to increase the amount of capital. So if you look at Credit Suisse, it actually had quite a lot of what you would regard as kind of safe capital. And this time the problem is liquidity. And again, you go to the Library of Mistakes. For 300 years we've had bank runs. That is really what happened this time. People wanted their money back.
If you have more rules and regulation, I mean, those could also be classified as a library of mistakes. Yes. Are they going to regulate private equity, venture capitalists?
I think this time in terms of our basic idea is this time they probably won't do that much because there isn't as big systemic mistakes. There's the two problems. The main thing is what you classify as being a bank. And obviously in America they went way too high because 250 billion, we've seen that. I think more generally there is a kind of worry, and we haven't seen it yet, that there are all these areas where non-banks are operating. You mentioned private equity, hedge funds, insurance companies are in part of it, all the dark pools of capital. And every time you have a financial crisis, it's always about debt. One reason why the dot-com crisis didn't do that much damage is because there wasn't any debt in it. And this time, the debt isn't just in banks. And we haven't yet seen where people have had to mark things to market.
Yeah, when you look certainly at Credit Suisse, UBS, it's incredible to think of these large banks with footholds all across the world, but then it's one national entity.
You think of our lives, obviously you're way younger than me, but you think most of our lives, Credit Suisse was the epitome of the boring bank, is that it had an exciting bit, which was the American CSFB bit when I was kind of growing up. But the rest of the time, if you had a conference like this, and I've actually seen it happen, the chairman of Credit Suisse would arrive, And gradually what would happen, and obviously there are people leaving quickly because I'm so boring, but the chairman of Credit Suisse was always an absolute guarantee to have a lot of people at the beginning, and then gradually people would disperse, because he never said anything that was interesting. And Credit Suisse was supposed to be the byword for total boredom and sort of solid things in the middle. And now suddenly it got itself into trouble. I think if you look, it's been that pattern of pretty much every scandal that has happened over the past 20 years. There's been a bit of Credit Suisse in it. And I think that's why, on the one hand, you should feel sort of sorry for Credit Suisse, and we can come on to the issue of whether UBS has actually got a bargain. But you should feel sorry for them because they did build up all this capital, they had all this protection, and they got pulled out by the oldest trick in the book, which is liquidity. But on the other hand, if you keep on getting caught in every scandal, and on top of that, you keep on having your accountants raise questions, you say things which aren't entirely true, you do start that. So I don't think you can just blame it on a kind of liquidity crisis. There was a real problem of trust. You only want to take your money out if you don't trust an organization.
But it's also amazing to see such a small country, frankly,
Yes.
with such a small regulator, having to suddenly put this merger together in these two systemically important banks.
I think to me, that's one of those moments where, this is where we could be totally wrong. But what Adrian and I looked at is, you have had this big change. You remember back in the last crisis, we all thought this is a temporary government intervention. And also on top of it, you had China, the EU, and America all working together. Britain was in the EU then. Now, you've got 3 competing trade blocs. The whole atmosphere is very, very different. And on top of that, you've got governments, the Swiss decided, against a background where it's pretty much impossible to make a kind of consumer argument, but it's a great thing for the biggest bank to take over the second one. The Swiss decided they wanted to keep Swiss finance Swiss, punished some bondholders we were discussing earlier, which you might not have expected. But and I think that will probably set off a chain of similar thoughts in places like Germany. We've got Deutsche and Commerzbank, and maybe even on a European level. I think you're beginning to see, if you believe in having national champions as much as the people who are currently running the EU do, then I think it's a very short step from thinking that way to thinking we must have a European bank which is somewhere near the top 5.
I think we actually have a great Bloomberg chart looking at the AT1s being completely wiped
amazing.
out. So that's, it's great.
This was supposed to be the relatively safe stuff.
Not so for the Swiss.
No. The Swiss decided, strangely, that it was more important to look after pensioners.
So for
and
Switzerland,
who were equity. It's very good to look after pensioners, lest you and I get depicted as heartless.
the Swiss authorities basically see banking as strategic. Is that a turning point? Are we going to see other governments do that?
Maybe go all the way back to Orson Welles and talking about the Swiss being good at cuckoo clocks and banking, but perhaps they always was strategic, but this time they made it really clear this is a strategic industry. Yeah. I think the interesting comparison is with Silicon Valley Bank. You look at Silicon Valley Bank. It was not, I think it's very difficult to claim it was systemic in a normal financial way, but it was systemic in terms of the tech industry. And if you're Joe Biden, you're sitting there, you've labeled just about everything that has come your way by American. You've gone on, you've spent fortunes encouraging chip makers to come back to America. You've tried to set up American tech as being the great reason why America will outlast and outfight China. And then suddenly the bank, which is supplying those people, gets into trouble. That was the key of it. I think it was as much about saving American tech as it was about finance. Even though it was quite a big bank, Silicon Valley Bank, I don't think you can claim it was systemic in the same way as Lehman's was.
But we've been talking about consolidation in the European banking industry for over a decade. Is UBS just the first? And how are the U.S. big giants, JP Morgan, Citigroup and others looking at it?
I think the Americans, I saw an American banker last week who said, look, this is, honestly, get on with it. And there's 2 things about that. One, it's absolutely right, is that you talk to any of there probably maybe some here, but any of the people who run Europe's main banks, they have a list of people they want to merge with if the rules changed and you were allowed to go cross-border. And it does, economically, that makes sense. It is very hard to have a currency union without a fiscal union. Again, cue German outrage. and a banking union. It's very weird at the moment that you have these banks sort of stuck in different bits of Europe. And it's also, I think, something on the front that, the biggest 5 Western banks are all American. And now you've got the first national champion coming out of Switzerland. Well, as I said, maybe Germany thinks that Commerzbank and Deutsche Bank go together, or maybe Germany actually finally confronts the reality of being part of a currency union and says, maybe we need pan-European banks that could stand up to it.
So, but you believe we're going back to mercantilism?
I do. I think we're already there, and that's what's awkward about this crisis. Is it's landed just at the time that people are thinking entirely in terms of blocks, and that I think this will compound it. And I think the worry is that yes, there are ways you can see if you're Joe Biden, it makes sense to have. If you've got American tech on your side, you want to have American finance as well. But the worry is if you want to see mercantilism in operation, go and look at China's banking sector.
How much are central banks to blame for this banking crisis?
The underlying dynamic of did they raise rates too slowly and have they raised them too fast? The answer is, the people I think will look back and say they had to raise them quite quickly because they kept them low too long. So yes, that bit. I think the people who now jump onto the next stage and say, well, we should stop, I think are wrong. Because I think the basic, you just saw the inflation numbers this morning from Britain. Inflation is still a big problem, and the idea of stopping that just to stop a little bit of pain in the banking industry at the moment, to me, feels wrong.
Is this a change actually for capitalism in general?
I think it is underneath it. I mean, you look, there have been great cycles in finance where things go backwards and forwards. But in terms of the rhetoric that you're hearing now about banking, it is completely different to what you were hearing even back in the financial crisis, but certainly very different to what you were hearing before that. And it's, banking always goes backwards and forwards a bit. Just look at the different ways in which Glass-Steagall has been imposed, taken away, sort of brought back. Maybe another bit of it may come back again. There are these different trends in banking which always go backwards and forwards. But at the moment, for bankers to sit there, or for the investment community to say, look, we're global, well, the answer is you're not that global because you're not allowed to take over each other. But secondly, actually the rest of the economy is going regional at the moment. So you perhaps should not be surprised when governments start thinking about you that way too.
Is the banking crisis over? This is the kind of question after the turmoil that we saw in the last 5 days.
The simple answer, none of us know. But my suspicion is that rates rise, you're always going to find some people who've got difficulty. My guess is that the next lot of difficulty probably will be in the non-banking sector, where people have been able to hide things more in terms of how they value things on their private, especially private institutions.
John, you're a great student of history, actually. So how do you think historians will look at this period, 2023?
I think they might look at it as a sort of second, they will look at it in the context of two things. One as being sort of part two of something that happened back in 2008, 2009. I think they will look at it more generally in terms of we had a period of open markets, and somewhere during the Trump presidency, and certainly compounded by the Biden presidency, we went from a global world to one that was much more regional. If you go to Paris or Berlin at the moment, it's a bit like visiting the kind of English countryside in the 1970s. All people talk about is the IRA, but it's not then about terrorists. It's about the Inflation Reduction Act. The Europeans are spitting mad with the idea that Biden, yes, he's introduced green subsidies, but he's also said those only apply if you buy American-made stuff. And if you keep on doing that, the Europeans, some of them are mad about it, others sense opportunity. They can now build the fortress they wanted to build always, and which was stopped by evil Anglo-Saxons who used to be part of their union, or whatever it was.
John, thank you so much.
Thank you.
It's a great piece, so you can, we'll push it out on social media, but you can also find it on the website.
Thank you.
Thanks, John.
Please welcome to the stage Man Group CEO Luke Ellis with Bloomberg's Danny Berger.
Really looking forward to this conversation. And Luke, you know, it's interesting. I know when the Bloomberg Live team dreamed up this conversation, we thought it'd be dominated by inflation. And here we are. It's the banking crisis, as we just heard, that's taken center stage. And Francine and John teed us up really perfectly, because I actually want to start where they left off as to whether this crisis is over yet. What do you think?
So no would be my answer. Sorry, John, if he's left.
Okay, perfect. Panel over.
Yeah, exactly. But I mean, again, depending what you define by crisis, I think that we will have a significant number of more banks that will not exist 12, 24 months from now that exist today. Which ones will be taken over? Which ones will have a shotgun marriage as we had at the weekend? Which ones will disappear of their own accord? That's a question. Clearly, the central banks and regulators are trying to stop things disappearing of their own accord, but I mean, the shotgun wedding is all with us. I came in this morning and the headline was, oh, you know, it's all great at First Republic. The shares were up 30% yesterday. It's all over. And you're like, the miracle of compounding is just to remind everybody. So it was up 30% yesterday, yay. But that means that it was, as opposed to being down 90%, it's now down 87%. Right? I mean, 30% when you're down 90% is really nothing.
Is that where the risk is when you say that some banks might not exist? Is that where you're looking toward these more American regional banks? Or is it another Credit Suisse type bank that, at least at one point, was one of the most systematically important?
So it definitely applies to smaller. So whether it's regional banks in the US, it's challenger banks in the UK, it's, you know, in the end, what this has all reminded us is in the modern world where everybody's got a phone in their pocket, and if they want to move all their money from A to B, you can do it while listening to me, and you probably won't even miss anything I say in the time it takes you to move all your money from bank A to bank B. What that means is that you know, at any time of stress, people are going to move their money to one of the banks that they think the government is behind. And that means the deposit base of any of the smaller banks becomes flighty. And the moment you've got, you know, banking doesn't work if you haven't got a stable deposit base, as we've just seen. And they are naturally less stable now.
I think this is a really interesting point, because not even just with mobile banking, but technology also allows us to tweet any concern we have about the bank, for VC founders to tweet saying they're advising all their companies to pull out money from a bank. Does this show us what crises will look like from now on, given the technology-enabled nature of them?
So yes, things happen at a much faster speed, whether that's a crisis or it's good news that, like, information travels much faster. And so, yeah, you know, look, we had a run on a bank with no newspaper headlines, because it happened before the newspapers had even got there, with no queues around the bank. You know, that's how the modern world works, and it throws certain parts of the banking system into question, and therefore regulation's got to respond to it, and it sort of means the big, highly regulated banks, where they are too big to fail, become the place everybody's going to have an account open that they can move their cash to at the last minute. It means smaller banks are going to have to pay higher returns on deposits, and that then means they're in, you know, they haven't got a critical advantage.
Right. How are you thinking about how that translates to the wider economic environment? Mike Wilson over at Morgan Stanley thinks that there could be a credit event. The latest Bank of America fund manager survey also says that a systematic credit event is now the highest risk over inflation. To you, what is the biggest risk?
So I think there's a causal link in there. So we still have very significant inflation. The UK just showed it's not going down monotonically.
Still double digits?
It's still double digits. That is scary. You know, the US still has an inflation problem, and particularly when you look at wage inflation in the services industry, you know, while that is 6, 7, 8%, you're not going to get back down to 2% inflation. The Fed, you know, I mean, it was really sort of easy to forget Powell's presentation to the Senate 2 weeks ago. You know, with everything, what he was saying is we have to push harder, and effectively we have to break something, right? In order to get inflation down in the US, I'm afraid that if they want to get it back to 2%, they have to have more people looking for work than there are jobs available. You know, at the moment that ratio is the other way around. One, you've got that, then yes, you've got the sort of negotiating power is in the employees, and so you get wage inflation. If you want to get inflation, anyway, so they sort of have to break some stuff. I mean, this bit when people say, yeah, we're going to get rid of inflation without breaking anything, we're not going to increase unemployment, we're not going to, like, something's going to break.
Right.
And, you know, we're seeing part of it is in the banking system where people got into the wrong position. It will, so I think it's a sort of, you start with, if you want to get rid of inflation, then they have to keep rates high enough to cause pain, and that will break things. Something at the boundary will break, and then you have to deal with it.
What do you make of the argument that, and you alluded to this, something has broken, now the Fed can stop, other central banks can stop?
In a difficult way of saying it, not enough has broken. Look, I mean, Credit Suisse is big news because it's a brand name that we all know throughout our career type of thing. Even, you know, but the reality is Credit Suisse has been, I don't know, I'm not sure whether shooting itself in the foot is a polite expression anymore, but, you know, they've been sort of working their way up both legs with a gun for the last 5 or 6 years. You know, I mean, like I mean, it's a constant thing. And so it was inevitable that, you know, Credit Suisse wasn't going to survive. And it happened that, you know, it's this last squeeze is what did it, with a sort of demonstration of a sort of run on deposits. But, you know, that one is relatively unique. While the problems are in smaller banks, whether it's regional, whether it's local, sort of, it isn't an existential risk to the system. You know, look, if we get to, you know, pick your favorite, but I mean, Bank of America is the one with the biggest unrealized losses in their hold to maturity box. You know, I mean, I don't think there's a problem there. I don't think there will be a problem there. But that's the, you know, if we end up there, then we know we're in a real crisis.
In terms of that, it has been a period we've seen over the last week of assets that are considered risk-free or close to risk-free have been the demise of SVB. AT1s in Switzerland, more risky than perhaps most people had thought, given that they've been zeroed out.
I got to say,
yes,
you know, the one rule of investing in credit is you've got to read the document, right? And it said in the Credit Suisse AT1 documents, I mean, it said what would happen. The Swiss government wasn't pretending. The rules are different in Switzerland than they are in the UK, or they are in France, or they are in the US. The US banks don't use this stuff as much, but the one rule in credit investing, and this is, you know, to that question that sort of might, you know, will a systemic credit event cause the problem? Will a, you know, I don't think we've seen the lows in equities for this cycle. Personally, I think we have a big sell-off somewhere in our near future. I mean, I don't mean this week, but I mean, you know, coming. Could it be caused by credit? Will it be caused by earnings first? Don't know. I mean, you have to see how it develops. But people who, you know, if you invest in a bond or you lend money to someone and you don't read the document, you deserve whatever happens to you.
but is it not a symptom of the zero rate environment, that people were taking more risks and paying less attention to them? Are there more shoes to drop?
Yeah, I mean, look, yes, people got used to I mean, for 10 years, there was effectively no credit risk in the world because it's quite hard to go bust as a company when you can borrow money at zero forever, right? I mean, it's like you have to work really quite hard to make a mess of that because money was free. You know, there was no reason to have a diversified portfolio. You know, this is about strategies for wealth creation. For 10 years, diversification was stupid, right? You wanted the most concentrated portfolio you can have. There was no point in risk management. If it went down, you just bought more. And that was the right strategy for the 2010s, all the way up until, you know, we got to 2022. But once inflation is out and in the system, as it now is, I would say it's exactly the wrong strategy. And so in a pivoting from, you know, there's a lot of people still sticking with, yeah, but, you know, I just buy every dip in equities and hopefully it'll work out. But I don't think it will for the next 5-10 years while we have an inflationary period. You know, diversification really helps in that type of thing. Risk management really helps. And, you know, I think you want a completely different portfolio. Obviously you did in 2022, but I would say you do for the next, I would guess this is the rest of the decade type of thing.
Have you seen that change in what's in demand at Man Group too?
So, you know, our client base is institutional and they move at the speed of their organization structure. So you can see the change happening gradually, but it doesn't happen overnight. You know, the things they're asking about today are different than they would ask about 12 or 18 months ago. You know, there's just a time, you know, it takes an institution years, not weeks, to put their portfolio where they might want it for the future, which is one of the challenges.
Right, and it does feel as though we've been lurching from crisis to crisis in this market environment. How have your conversations with clients changed as crises take different shapes in very different ways, but again, that concern is still there?
Well, look, I think the bit is every client essentially came into 2022 with a max long equities, whatever the rules were, the maximum amount they could be long equity, they were long it, maximum long private markets, assuming that, you know, government bonds were their hedge if they needed it, but their government bond position was smaller than it had ever been. One of the bits of that is whatever they told me in 2015 max long equities was, the max long was now bigger, right? So they'd all done that thing where it was working, so we'll increase the limit, And obviously that was exactly the wrong portfolio to have in 2022. And so they come into 2023 and go, okay, how do I think about the right amount of equity beta to have in the portfolio? How do I think about how much private risk is okay? Am I getting paid for the illiquidity? Because the point is you're supposed to get a premium return for it. And you would think people would like government bonds more at 4%. If they like them at 0, you must like them a lot at 4. The reality is when they own them at 0, they thought there was no downside. You know, maybe you could lose 1 or 2% in my bond portfolio, but that's it. You know, now they look and go, okay, it's a 15 to 20% downside in bonds. That means people aren't suddenly increasing their bonds. So I would say clients are trying to figure out what to do. You know, I sort of obviously think liquid alternatives are a good answer to the problem. And, you know, I think enough clients are moving in that direction that the next few years should be a very good time for flows into the hedge fund business. I would say that, wouldn't I? But you know, the point is what people want is something which is liquid, which made them money last year, which, you know, that's sort of, it's a pretty short list.
Yeah. I mean, to that point, all of the AHL systematic strategies posted positive returns last year, which is not a lot, is something most hedge funds can't say. But systematic strategies, a lot of that underneath there is trend following. How does trend following work when the trend at this moment is just pure volatility? Treasury yields up one day, up 20 basis points, down 20 the next day.
So the systems adapt. Look, I mean, I've got to say, and you can see it on our website, you know, we were positioned with Powell, the systems were positioned with Powell, and so, you know, when the first sell-off in rates came, that wasn't good for us, but that's, you know, that's what happens with systems. The bit though is they adapt, certainly ours, adapt very quickly to changes in volatility. So with the volatility you've got now, we run much, much, much smaller positions than when markets are calm. I think that's a rational, you want to take a certain amount of risk when markets are highly volatile. It needs less notional to take the same amount of risk. When they're less volatile, you can afford to take more. So, you know, we would naturally run lower positions, and you can therefore adapt to the market changes quickly.
What do you think is the most successful environment for these types of strategies? Last year was obviously it. What made it successful? How does that get recreated?
So for anything that's about alpha, right? Whether it's trend, whether it's stock picking, it's, you know, in the end, the amount of alpha you can generate is the product of the skill you've got multiplied by the opportunity set, and the opportunity set is best thought of as dispersion. If everything goes in the same direction at the same time, it's impossible to add value through selection, right? So, you know, it's sort of simple to think of it in the long-short equity world, because everybody could think of, if all stocks go up and down together, there is no opportunity, however much skill you've got, there's no opportunity to add alpha by being long one and short the other. The more dispersion there is in outcomes for shares and sort of by definition for companies, the more opportunity there is for stock picking alpha. The same is true in the macro strategies, the top-down strategies. If all markets go up and down together, it's not good for us. The more dispersion there is, the better. Our skill is positive in every market, but it's small in a single market. You need the dispersion across hundreds of markets to get the high skill. And, so sort of the best, we've tried over time to build a model for dispersion, to predict dispersion. We haven't been able to. I don't know anybody who has. But a heuristic to think that inflation creates economic uncertainty and economic uncertainty creates dispersion is a pretty sensible heuristic. And, so like last year was very good, but actually we've been making money for the previous 10 years, even though the environment wasn't good for us.
Right.
I feel like we're going into a world which creates a lot of alpha opportunity if you've got skill. There's you have to have that skill bit, because if you have lots of dispersion and you're long the wrong thing and short the wrong thing, just means you lose a lot of money.
Right. And while we're on this topic, we do have an audience question, which feel free to send them in as we're here in the final minutes. Someone's asking about algorithmic trading. Are there opportunities to leverage systematic trading and AI to find investment opportunities?
So we've been using machine learning. I always slightly worry about the word artificial intelligence, because it's a mathematical process. You can decide whether you think that is or isn't intelligence. I'm not sure it's the bit that we credit as intelligence, but we've been using machine learning techniques for 6 or 7 years. And they're good at some things in investing, and they're not very good at other things. The reason the ChatGPT stuff gets so much coverage is that the place where machine learning is really effective is to consume all of the words that are out there. So take all the research reports produced by the banks. It is millions of pages of stuff, and it's sort of impossible for humans to read all of that. And machine learning techniques can read it very quickly. And so for consuming words and summarizing them or giving you nuggets of information, machine learning is very good, and we use it very actively for that. If, on the other hand, you chuck a whole load of market prices at a machine learning process, the nature of machine learning, the question of why I put inverted commas around the I in artificial intelligence, it always thinks there's an answer. So if you throw a load of market data, a machine learning technique will always find a pattern that means it wants to take a position. The reality is the vast majority of market data is noise, doesn't have information in it. And it's really hard to get machine learning techniques to be parsimonious about when they trade, when they don't trade.
And just a minute to go here, Luke, but how good is it in spotting crises? And I ask this because we have a question saying, could AI spot issues in banks like SVB in the future?
So as I say, I think it's very good for getting through words. It's an interesting. I don't know. You needed. Look, I'm not a regional bank investor, so not my specialist subject. But I would say I don't think you needed an AI to spot a potential issue in SVB. I think any time you see something anywhere in finance where their growth rate is unrelated to the market growth rate, you want to worry. You can take market share in percentage points. You can do better or worse. But if you look at the deposit base of SVB, it grew at a rate that is unlike anything going on in the rest of the banking system. Finance is too competitive a business to have something that's an outlier like that. right? And so anytime you see an outlier, as opposed to thinking, in a real tech business, you can get things that are outliers and compounders, right? I mean, Bloomberg's a great example. I think it's, probably the most successful fintech business there's ever been, right? And it's a compounding advantage. But in banking, I mean, there are how many thousand regional banks there are in the US. To have one that's suddenly doing a profile that's completely different than the others, it's more likely to be a problem than it is that they've invented some completely new way of doing banking.
Right. My takeaway from this is always read the documents.
Always read the documents. It really is a good answer.
Luke, thank you so much. Everyone, please join me in thanking Luke Ellis, Man Group CEO.
Thanks very much. Lovely. Thank you.
Please welcome to the stage Lombard Odier Group Senior Managing Partner Hubert Keller with Bloomberg's Lizzie Burden.
Welcome everyone to our next panel. It's sustainability focus, investing to achieve net zero. The question we've been asking here at Bloomberg is, in the race to achieve net zero, where we should be putting our money. And to answer that, we have Hubert Keller from Lombard Odier. He's Senior Managing Partner. Thanks for joining me, Hubert.
Thank you.
Before I get carried away with my own questions, I'm sure that everyone has their own questions in the audience, so please do send them in using the QR code. Don't forget to do that. And you can get involved with the hashtag BloombergInvest. We've brought you to discuss sustainability, but I've got to ask you, you're based in Switzerland. How confident are you in the sustainability of Switzerland as a banking centre?
Thank you. I always knew over the last few days that being the only Swiss banker on the panel was probably going to attract a few complicated questions. So I think it's really important to keep in mind, of course, the Credit Suisse situation is very unfortunate, but it's very important to keep in mind that Switzerland as a financial place has been built on the strength of its wealth management franchise and particularly on the strength of its cross-border wealth management franchise. I think it's really important to keep this in mind. Switzerland is the largest place for cross-border wealth management in the world for a number of reasons that have not changed with Credit Suisse. And those reasons are linked to the political stability of the country, of the economic stability, of the expertise in banking and in wealth management that has been built over so many decades, even if not more. And those attributes remain in place. One would argue that the way that the Swiss authorities have dealt with a very complicated situation so swiftly and so rapidly is probably another evidence of the stability and the solidity of the financial place. And I think another important point to bear in mind, the Credit Suisse wealth management franchise is a very strong franchise. And the problem of Credit Suisse came from the global markets and the investment banking side. So, I certainly belong to those who think in Switzerland that we need to continue and we should continue to strengthen and invest in our core expertise, which is cross-border wealth management. And I'm still quite hopeful and feel that this is going to be a very sustainable value proposition for the future.
And you've been a strong advocate of the green investment opportunity. Are you using your green credentials to try to woo some of Credit Suisse's clients over to you?
Look, there is no doubt that there will be some changes with clients as a result of this situation. And the reason is that most wealth management clients or wealthy families, they tend to want to bank with a few banks. So there is going to be a diversification effect, which indeed is likely to benefit the rest of the wealth management industry in Switzerland. But again, overall, it's a very unfortunate situation.
And how far are you looking past all the negativity now and actually thinking about positioning for the pivot? Because we know that the days lost now equal years in terms of catching up later.
So, this is a really interesting point. We obviously, Lombard Odier is an investment firm, and we manage money for private clients and institutional clients. And as an investment firm, we indeed are very focused on all these short-term considerations that are really complicated, ranging from inflation to monetary policy, obviously the geopolitical situation, and now perhaps the issues arising in the banking system. What we are always saying to clients is that when you look past these short-term issues, we think that we are in front of basically a green economic revolution, which could become the growth story of the next 2 decades. And very much like, frankly, tech or IT and tech revolution has been the growth story of the last 2 decades. And it's really interesting to understand how things are developing. And I think we have a tendency of underestimating not only the scale of the environmental issue, but also the scale and the speed at which innovation have come through. Because climate and the environment has been such a big and recognized problem for so many years, actually, we've seen a lot of innovations in the last few decades to try to basically address this problem. In fact, I would argue that climate and environment have attracted a lot of the innovations. And what is also quite interesting is to really understand how innovations go through the economic system. And obviously it starts with innovation, it moves to niche market, and then at some point there's an inflection point that is crossed. And when that inflection point is crossed, that innovation moves into mass adoption. That's where the scale story comes through. And this is the place which is really interesting as an investment or for investors. The interesting point is that this inflection point normally requires a few criteria. And they are always the same. It's about price or affordability. It's about whether the new solution is more efficient than the incumbent one. And it's also about accessibility. And when you look at the environmental issues at large and climate specifically, what is really interesting, which is again very underestimated by a lot of people, is the fact that 90% of the solution to sort out the environmental crisis today exist. 90%. And some of those solutions have already gone through this inflection point, like the building blocks of electrification. And we see this sort of scaling up of these solutions, and many others are between 2 to 3 years, we think, of crossing these inflection points. And that's really quite interesting because the reality is that when these innovations or these green technology solutions start to scale, which again we are seeing right now as we speak in the building blocks of electrification, then they attract a huge amount of corporate investment capex, because then the business case for companies to start to invest becomes very clear, and they often lead to considerable changes across economic systems and lead to profit pool shift. And again, we've seen that again with the internet revolution in the last 20 years. It has completely changed entire industries and shifted profit pools around and changed economic systems. And that's, as an investment firm, why we get quite excited about it, as you can see.
So I want to take the temperature in the room and see if everybody's as excited as you are. We're going to do a live poll. And the question is, are you convinced by the opportunities presented by the green transition? Yes or no? So if you scan the QR code, you can tell us what you think, and we'll come back and get the result in a bit. Hubert, in your view, as you say, economics is the major driving force behind this green transition forward. How important then is policy action? Is it as important?
It's a really good question, because a lot of the discussion is around policy action. And policy action is important, but it's really important to bring forward this inflection point. The scaling up of green solutions, green technologies, is really going to be down to the law of economics. So what, if you take, for example, I don't know, heat pumps in the US, heat pumps cost $10,000, whereas gas-fired boilers cost, I don't know, $7,500. So to have a green subsidy of $2,500 to basically, for each one buying a heat pump, is going to shift the demand towards heat pump. And that's going to be very helpful because over a 3 to 5 year period, the cost of heat pumps are going to go down. They're going to become on their own more economic than the incumbent solutions. So effectively, policy action is helpful to bring forward these inflection points. Absolutely. But again, when we look at what's happening with electrification today, it's gone much beyond policy action. It's important to realize that our entire energy system, the demand for our energy, basically 95% of the demand is concentrated around 3 clusters: mobility, buildings, and industries or industrial processes. And what is really interesting is in some of these clusters, like mobility, but it's also true in buildings and industry to some extent, we are moving towards the green solution. If you take electrical vehicles, for example, there is a faster and faster adoption of electrical vehicles in the world. 10 million electrical vehicles have been sold this year. That's about 12%. We think in the next 3 years, it's going to be 30% of new car sales. And they are being adopted because, again, affordability, accessibility, and efficiency. And those are the reasons why these sort of green solutions are being adopted. And this is the reason why the demand for energy is starting to become much more about electricity. As the demand is shifting, then we see the potential of unlocking renewable energy supply for a very simple reason, because as the demand for energy is being electrified, effectively the cheapest source of electricity today is solar and wind combined with, obviously, batteries. And this is why all new electricity supply in the world today, 90%, is done through solar and wind. And this is, again, the law of markets that are at play because it's cheaper and because there's more demand of electricity, there is more solar and wind being deployed.
I think we've actually got a chart of power by generation sources as they currently stand. So this is according to Bloomberg NEF data. And let's also just get the results of that poll that we did. Are we convinced by the opportunities presented by the green transition? Hooray, you're winning.
Oh, so far. Still have 40%.
57% say yes, 43% say no. So more work to do.
More work to do, yes.
We've also got some questions from the audience. Someone says, what innovative alternatives have emerged to finance the multi-trillion renewable energy financing gap?
So I think it's a really good question. And the reality is that I'm not sure there is much innovation around this. The reality is that as these solutions, and we can really see this with electrification, are ready for mass adoption, the business case for investment capex to be deployed is becoming very clear. We think as a firm that there is going to be 24.5 trillion of corporate investment capex being deployed as we speak between now and 2030 to finance the electrification of the economy. Electrification is going to be extremely capex intensive. We need to basically lay out 140 million kilometers of transmission distribution cables. The list is really, really long. But the reality is that because the business case is becoming clear, there is now corporate capex ready to be deployed and being deployed. And as investors, this is really interesting because when investment capex are being deployed from corporate, it is because they are investing in future earnings of their own. They're investing in the future growth of their own P&L. And so as investors, basically, we want to follow these capex. And it's really interesting when you look at electrification, we think this 24.5 trillion is going to translate into 3.5 trillion of investment capex being deployed this decade. And if you look at the tech revolution, we were also looking at 3.5 trillion of capex being deployed year in, year out for effectively more than a decade. And that is also quite interesting because if you look at sort of 20, 25 years ago, or maybe even more, the share of earnings from tech companies were 5% in the global economy. It went to more than 20%. And this is just to give you a sense of the scale of the opportunity around the green transition. And CapEx is being deployed as we speak.
And finally, a last question from our audience. Do you think the green revolution you describe can be achieved in Europe under the SFDR regime? Sam Turvey at Advisors Maitland says there's some negativity around it.
So I think, so when we speak to clients, we always try to make a distinction between two very different discussions. The discussion that we just had is about green alpha, and it's about investment returns, and it's about investing in companies that are well positioned to capture these new profit pools that are going to emerge or rise as a result of the environmental transition. That's the green alpha discussion. There's another discussion which we want to have with clients, and this discussion is where, frankly, most of the focus is on the regulatory side, on the media side, and in the general public, which is how much of my portfolio is contributing to the environmental transition. It has a notion of positive contribution. These two discussions are distinct and completely separate. So what SFDR is trying to do is to basically engage in that second discussion. And we very much welcome what's happening with SFDR and with the EU taxonomy in particular, because it is encouraging our industry to create transparency on how much portfolios are actually contributing to the environmental transition. And it's forcing our industry to move away from what I would refer to be the sort of ESG 1.0, which is just about data and it's about business practices. It's about how companies do things as opposed to what companies do and whether in what they do they are really contributing to moving this transition forward. And I think what SFDR is doing, frankly, very much with the support and backed by the incredible work done by the EU taxonomy, is trying to create transparency on how much portfolio are contributing to this environmental transition.
All right, well, that's all we've got time for. Hubert, thank you so much for joining us. It's been really fascinating, and I hope you can win round that 43%. Please give it up for Hubert.
Thank you. Thank you very much.
Please welcome to the stage Goldman Sachs Senior European Equity Strategist Sharon Bell, Ruffer LLP Partner and Investment Director Alexandra Charteris, and Principal Asset Management Chief Global Strategist Seema Shah, with Bloomberg's John Stepek.
So, good morning. I'm here today. I'm joined very kindly by Alex Charteris of Ruffer. Alex is their Chief Investment Director and co-manager of two of their flagship funds. Sharon Bell, Senior European Equity Strategist at Goldman Sachs. And Seema Shah, Global Strategist at Principal Asset Management. Now today, I believe we've got a chart which sort of sums up what today's session is going to be mostly about. And so what this shows is the yield on the US 10-year Treasury going back over about 45 years. As you can see, it's been going down, and now it isn't. And that's basically what we're going to be talking about today. I know that's 40 years. That is probably most of the people in this room, if not all the people in this room, investment careers, investment kind of savings time. And so this is a massive change. And one of the big effects is something that people have already talked about this morning, which is the current banking crisis. And I think it's very hard to ignore that and launch straight into the inflation discussion. So Seema, how do you think the banking crisis is unfolding? Do you think that they've drawn a line under it with the Credit Suisse UBS rescue, or do you think there's more to come?
Okay, so first of all, it's interesting that you said about the merger, because when we write notes, in one line it's a merger and the next one it's an acquisition, and we're always fighting with that one. Okay, so look, I do think that this banking crisis is really pertinent to this issue. So I do think that policymakers have done almost enough to ring fence these really unique issues. We've already talked about that this morning. But the reason that we're having this banking crisis is essentially, I think, down to the fact that central banks have had to raise rates in order to fight inflation. So now from here, I think there could be further stress. If there's further stress, I think policymakers are going to step in bigger size, do whatever regulators and central banks, authorities need to do. But it does have an implication for the inflation story, because, let's say that this month everything is fine. Let's say that the stress is gone. Central banks, the Fed can raise interest rates this evening, 25 basis points or so. And then everything's settled down. But imagine next month if you get a surprise upside print for CPI, right? The market is going to get really stressed out at that point. Policymakers are going to have to, I think, potentially step back. And at that point, they're almost admitting that fighting inflation is something that they cannot do. And it's, I think, an implicit acceptance of the fact that they cannot get inflation back to 2%. So I think it's pretty pertinent to this discussion.
Sharon, what about you? What do you think?
Yeah, just following on what Seema's just said, I do think central banks, we tend to think of central banks as fighting inflation, and that's their primary goal. But actually, their primary goal is always financial stability, superseding inflation. And of course, sometimes those things are fine. You can work on those together. And if you're not in a financially vulnerable time, you can fight inflation and raise rates, etc., as we have been seeing. But as soon as you see, and the UK last year during September was a really good example of this, during the pension LDI problems, where the Bank of England was literally just about to start doing quantitative tightening. They were going to start selling bonds. And they stepped back from that for a while in order to solve for their primary target, which is financial stability. And they said, actually, no, we'll provide liquidity. Actually, no, we'll start buying back bonds again. They were very careful to try and do so without creating moral hazard. But nonetheless, that is their primary target, to create this financial stability. So I do think central banks and regulators, even with this inflationary problem in the background, will still be, as their primary target, trying to make sure there's liquidity to the banking system, financial stability. And I do think the banking system has genuinely improved in the last 10, 15 years since the financial crisis. All the regulation has meant much lower levels of leverage, higher levels of capital, etc. Of course, in the end, the banking system is confidence. And if that starts to disappear, then you still have a problem. But, it's a dual mandate, really, for central banks. And I completely agree with Seema. If you're going to focus on the financial stability side, you're letting go of the inflation side of it for a while.
Alex, I'd like to get your take on that point, but also to kind of maybe take that forward a bit. Isn't one issue, though, with a banking crisis that it is in itself massively deflationary? So if we get a sort of... We're kind of operating under the assumption that this isn't 2008 again. And I can see why, but what if it is more drastic than this and it spreads further?
Well, why isn't it 2008 again? Probably because the capital regime for the big banks is much more secure. Why should you still be worried about the potential tightening effect of a credit crunch on the real economy? Because, well, if you're a loan officer somewhere, is this all making you more or less likely to lend credit to the real economy? Less likely. That's going to have pretty fundamental implications. For example, in the United States, I think we all know the stat, it's something like 70% of commercial real estate lending happens out of the regional banks. The regional banks, the epicenter of the problem. This is a classic example of Maginot Line-style generals fighting the last war. They ring-fenced the big banks, they tried to protect them, and guess what? The problems cropped up somewhere else. So whack-a-mole continues. So credit risk in the real economy, yes. Inflation risk is the flip side, because of course we know exactly from the violent agreement points we just heard that the revealed preference of central bankers is to dump money in the system when there's a financial stability issue. But remember, you mentioned the Bank of England. Most modern banks founded on the template of the Bank of England in 1694, not founded to control inflation, founded to get the government's debt away so we could rebuild Royal Navy after a drubbing by the French. Right? Central banks are wholly owned subsidiaries of governments, and that's the role they are going to revert to. So don't be fooled by the noise. Ultimately, this is a world we're going to have to monetize a lot of debt over time by stealth, preferably, so there isn't a kind of massive shock. But that is the direction of travel.
Okay, so we all seem to agree that inflation, rather than a kind of deflationary bias, is going to be what we're getting for the foreseeable future. By the way, I know Francine showed you all how to use that Q&A thing this morning, so do send up your questions as we're talking, and if anything particularly exciting crops up, I'll pick it up and throw it to everyone. But yeah, so to carry on, so last year the 60-40 portfolio, traditional asset allocation, equities, bonds, had its worst year in really, well, ever, pretty much. Is that a sign that something very fundamental has changed? And if it has, then what do we need to be considering as individual investors when it comes to our future asset allocation or how we think about it? Sammy, you're in the hot seat again, I'm afraid,
I know.
sorry.
I wish I'd repositioned myself back. Okay, so last year was, as you said, it was a terrible year. Was it a unique year? I do think it was. Do I think it's going to go back to what it was before, where 60-40, I mean, in fairness, 60-40 hasn't really performed that well for a while. But will it go back to at least moderate performance? I think so. You know, we're probably going to go back to a time where inflation is a little bit higher than what we've had over the last decade. So in that situation, you know, maybe we don't have such a strong performance. I do think for 60-40, and this is, you know, you can see from the sessions later today, that people are thinking outside the box, right? It's not just about traditional equity, traditional fixed income. If you want to get any kind of yield, if you want to have any kind of returns for your portfolios, you almost have to step outside. And whether it's private credit, looking at alternatives, infrastructure, commodities, I think that has a bigger role to play. And real assets, it has to play a role in the next 10 years if you believe inflation is not dying.
Sharon?
Yeah, I mean, again, violent agreement, as you were just discussing. So I think that adding more real assets into your portfolio makes a lot of sense if you think that inflation is going to be more persistently high. And I think it probably will be, given the sort of resource constraints globally we have. And I do have sympathy with what Alex is saying. In the end, governments have large amounts of debt, and they will mind a little bit higher inflation this next cycle because it deflates that debt effectively. So I think given higher inflation, we're going to have a bit more of a mix in our portfolio. And I think 60-40, it's an interesting one. In this most recent sell-off, it would have buffered you a bit because the bond market rallied. So I don't think it's completely dead as a concept. I just think that perhaps adding some of these real assets in does make a little bit of sense as well. I also think it makes sort of a sense to consider, I mean, maybe for 10, 20 years, that chart you showed previously, that very first chart you had up, with bond yields collapsing over time. I'm an equity person, and I was often sort of asked, why bother with equities? You know, the bond market does so wow for so long. But of course, equities ought to provide you with some inflation protection. They are an ask on the real economy, effectively. And we have seen inflation this last year, and yet company margins held up quite well. I mean, inevitably, equities are cyclical, and they've been hit in this current crisis. But they also provide some inflation protection. So again, the argument for having those in the portfolio is quite strong too.
I mean, yeah, Alex, again, we mentioned real assets. I mean, what do we mean by real assets?
Real assets give you a claim on effectively inflation-protected flows and more expansively against debasement of fiat currency. So we've got some of those in the shape of inflation-linked bonds and gold and equities, as long as you pay the right price, are in that mix as well. But if we could just come back to last year and the 60-40, because it is a really critical point. We don't think inflation is just going to be high and stay high indefinitely. We think volatility is the watchword, precisely because we're going to get breakages like these in the financial system that will create deflationary lurches, that creates an inflationary policy response, and that's really difficult to navigate. So sometimes bonds are going to work. But last year, the real lesson is that if you are solely reliant on conventional-only assets to diversify your portfolio, there are going to be times when there are no hiding places. We've been worried about that for a long time, which is why we use derivatives, and that's how we delivered a positive return last year. But the historic context here is pretty simple. The entire financial industry pretty much operates on the assumption that bonds and equities are pretty consistently offsetting. That's only true for the last 20-odd years. And the reason it's happened the last 20-odd years is that inflation has been consistently on average below about 2.5%. And below that level, central banks do not have to worry about inflation getting out of control. So they can cut rates and print money, and that mechanically lifts bonds. But if there's even a little bit more inflation, we're not talking about Weimar wheelbarrow wage territory here, just over about 2.5%, maybe it's 3%. Maybe 3% is the new 2%, then suddenly your bonds are less reliable. So the key is you need to be flexible, and we don't think you can afford to depend entirely on conventional assets.
I feel I need to ask this question, and also it's just popped up from one of the audience, so thank you for that. Crypto. Crypto was obviously an early casualty, rising interest rates, and FTX was the obvious blow up there, and pretty much the whole sector's been shaken out. But one thing I have to say that we've written about a bit here at Bloomberg is that Bitcoin has done really well this year. And I know that a lot of people kind of thought or even hoped that it was going to die along with the rest of the sector in the kind of rising interest rate environment, but it does seem to have some kind of staying power. So I'm just wondering if it's something that you ever consider for your portfolios.
Yeah, look, that's a really interesting question. So I remember last year going around the US, and I have to say I got a couple of questions a few times from people, well, not even questions, but comments, just saying that, look, you can't make money anywhere else, nothing is safe, so we're going to put our money in Bitcoin. So it was almost becoming this safe haven for some people, which was really bizarre. But I do wonder if, is that starting to return into some kind of psyche? I don't know. I will never understand that, I think. But I also say that last year, again, when we were interviewing people for asset allocation, so many people came in and said, when we said, present an idea, the one idea that everyone came in with was having Bitcoin in your asset allocation portfolio. 4% allocation, they said, was the perfect one. But every single candidate put Bitcoin in that asset allocation portfolio.
Why 4%?
Apparently, and I haven't done the maths, but apparently that is the ideal amount within a broad fixed income equities alts portfolio, is to then have a little bit of 4% in Bitcoin. Apparently, that is the ideal amount.
The magic number. Sharon?
I don't know. I think the problem with Bitcoin, so I understand a little bit why people have moved into crypto, because in some ways it's a competitor. It competes against the bank sector in a way, doesn't it? Against traditional money and capital. And if people are questioning, so whenever people question that, which clearly has happened in the last couple of weeks, people will move into something like crypto assets. I've also looked at this, that, if you popped it into your asset allocation with a very small percentage, maybe even less than 4%, would it really help? It does just up your volatility a lot, first of all. I mean, obviously, so it just creates risk. Maybe there's been good return over time, but how reliable is that? The other issue I have with crypto is that it doesn't correlate at all well with anything, and its correlations move a lot. So you can't sort of pin it down. In my sort of economics world, I like to say, okay, if I take a view on inflation or rates or GDP, then I have a good idea what will happen to bonds or equities or banks or a particular type of asset. With Bitcoin and crypto, I'd find that very, very tricky to work out. They don't have sort of very stable relationships.
John, don't go there. I know where you were going to go with that question, but headlines here, look, we had 5,000-year lows in rates. We got a lot of very frothy stuff driven by magic money tree real-time experiment. Crypto was the long arm extension of that. It got whacked first as a result last year. Maybe there's a place for certain digital assets in a properly diversified portfolio, but I think I just want to dwell on what Sharon said there briefly about the nature of correlations, because we're all addicted in the finance industry as a whole to the data sets that are available to us. The data sets that are available to us are basically the last 30, 40 years. And that is defined by the chart you put up at the beginning. Falling rates, falling inflation, falling vol, great moderation. And that is not a reliable gauge to how the future happens. None of us know what data in the future looks like by definition. And correlations are going to change. That's what I was saying about the 60-40 portfolio. So you've got to be flexible. You can't rely on, oh, great, data set says 4% optimal, to exactly your point, Seema. 4% optimal, based on what? Based on, Bitcoin's life for a little bit over a decade. I mean, so you've got to be flexible. You can't be wedded to old models, even if you think there's a little bit of change coming in. We think there's a lot.
And speaking of alternative assets, what about the physical Bitcoin or gold, as we prefer to call it? Do you think there's a place for that in a portfolio?
Well, I like to say gold is the new Bitcoin, John, so yes.
Sharon or Seema, do you have any views on gold? Or?
I don't know. It's that one question I really hate about gold, and it always comes up. Yeah, maybe yes, right? If you believe in inflation, the obvious place to go is gold. Is it interesting to me? No, not really. It's not the thing I go to. It's not a great answer, but the honest answer.
Just don't like it.
Yeah, I think higher inflation, gold is a kind of real asset in that context. And, I think having a little bit of a higher weight in a world of slightly higher inflation, 3% being the new 2% or whatever it is, then I think it makes a little bit of sense to have that bit in your portfolio. Yeah.
I think there's a bigger structural story which I'd also want to alight on, which is just we can feel the change in the air in terms of world order. Who was buying a lot of gold second half of next year after the Ukraine invasion? China and Turkey. Who's going to keep buying gold? Anyone who might find that their big reserves in dollars, euros, and European currencies are going to get weaponized. So I think there's a bigger structural buy going forward. I think in a multipolar, much more contested era, gold has a bigger role to play as a neutral reserve and FX asset.
During like a geopolitical risk being higher, basically. Yeah.
I mean, in terms of geopolitical risk, this takes us to another question that's come up. And this seems like it is a very extreme scenario. But, okay, so this morning, for example, UK inflation, we expected it to go into single digits, and actually it's bounced, it's going up, and it's still in double digits. There are a few countries around the world at the moment that are experiencing hyperinflation. Is anyone concerned that we might get either maybe not hyper, but kind of like much more significant inflation? Because at the moment we're sort of sitting thinking, whenever I'm talking about, okay, we're moving into a more inflationary environment, I get the impression we're all really just talking about between, 3 and 7%, say, for the next X number of years, and 7's probably, a little bit dramatic sounding. But is there a possibility that we get just wild levels of inflation? Is that something anyone's planning for or thinking about?
I think it's quite unlikely, very unlikely. I think the one scenario that you could see it happening, which again is very unlikely, is if, back to the kind of the labour supply issue, which is behind so much of the inflation, is in this new world, migration laws start to tighten further and further, and there's an outflow away from the west into the east, where there does seem to be greater growth prospects. Then maybe, but I think I doubt it. I think that the UK government, US government would hopefully reopen borders and try and find something to attract people back into the country.
And also, even though the labour market's very tight and wage growth has picked up and it's higher than perhaps the central bank would ideally like in the UK and other places, you've still got negative real wage growth, even with labour markets being quite tight. Labour wasn't able to extract out of its employer, whether that be the government or the private sector, enough wage inflation to actually compensate for inflation. So you don't have what you had in the 70s in a way, which was a bit this wage price inflation spiral. There's a little bit of that going on, I'm not denying that, but I don't think it's as bad as that, because you're not getting the deals which are inflation and then a little bit more, because I actually expect inflation to go up again. But I do think your question on the UK and the inflation print this morning is very, very valid. I was surprised by that. I think it shows you that perhaps, first of all, the UK economy is maybe not as weak as we thought. A couple of quarters ago, it would be unusual to meet someone who didn't think the UK was going to be in a recession right now. And actually, the data for the UK suggests it's not in recession. But if it's not in recession, that means demand's a bit better. And if demand is a little bit better, then that probably means inflation is going to be higher. Because labour supply is quite limited, because global resource supply is limited as well. So I think higher inflation, yes. The sort of really high hyperinflation, again, a bit like Seema, I think that's quite unlikely. I do think central banks, first of all, would step on that type of inflation. Yes, I agree, they may that they may be happier to have 2 to 3 or maybe 4% inflation, but I don't think they'd be happy to have 10.
Yeah, we're not in the Weimar camp for the G7. But look, relevant context here. The first thing is we do think that the next decade, say, will be characterised by a higher level of inflation than we've been used to post credit crunch. What does that mean? Well, who knows? But it's not going to be a stable 2%, driven by net zero, which we just heard something about. Wars, hot and cold, we're in the middle of a new Cold War, are always and everywhere inflationary. You've got monetization of the debt overhang. You've got all sorts of labour force issues and supply chain constraints we know about. But here's the really salient market point for us. It's a completely asymmetric proposition in terms of market pricing. Long-term inflation pricing, despite everything we've talked about, despite everything you hear in the headlines, flat as a pancake. And there's nothing in the market for higher levels of long-term expected inflation. You're being given a free hit. So if we do go back to the world we've been in, those long-term inflation expectations stay where they are, no change in price, happy days, other things in the portfolio work. But if it's right, there's going to be a big repricing, and you're going to get deeper negative real yields out across the curve. You're going to get higher long-term inflation expectations, which are currently flat as a pancake.
So in terms of, because I would like to just run through quickly the kind of equity area, because I know that's obviously where most private investors are often most interested. So Alex, you're just talking there about positioning yourself for an upward surprise in long-term inflation expectations, basically. On the equity side, what sort of things would you be buying with that in mind? What sectors or styles or countries, actually?
Price dependent. The only two things you can control are the price you buy at and the price you sell at. So if you pay the right price, logically, value is the place to be, because it's going to give you some kind of real return over a more inflationary decade. Lots of different flavors of value. You know, Japan, small cap, UK, mid and small cap, stuff full of them, those kind of places.
And any particular sectors that you're favouring?
Well, I mean, energy constraints, but obviously it's cyclical. But value is just a price question. It's not necessarily a sector. So you can find value tech, value hardware in the niches of the semiconductor supply chain coming out of Japan. There are lots of interesting opportunities there, and they don't trade rich.
Sharon?
Yeah, probably similar in a way. I mean, we've liked banks for the last sort of year, more or less, and for most of the time it's worked, but not particularly in the last couple of weeks. But I do think that value sectors, you can find lots of companies within sectors, and then broad sectors that look actually relatively inexpensive. So in Europe, there are 4 sectors. There's banks. But they're all bad sectors in a way from a sort of cyclical perspective. They're all cyclical sectors. They're all sectors with low returns, but they are sectors which are super cheap. Banks, mining companies, energy and autos. And they've all got their own particular issues. And you want to be selective within those sectors, but they're all sectors with very low, inexpensive valuations. And actually, in the world of slightly higher inflation, I think generally they will do better. And with respect to energy, well, I do not think we've been investing in energy for a long time. Investing in the transition, and we haven't even invested enough in renewable assets either. So a lot more investment in all of that. But while that's happening, prices for energy will tend to be higher, which is, of course, one of the reasons why we have inflation.
So just to jump in this, but on the banks, I know the argument obviously is rising interest rates, rising profit margins. Has the recent kind of disaster kind of change that story at all in your mind, or is that more just it's contained to them?
Yeah, so I think it's a tricky one, because in the end it's quite binary. If this all becomes much worse for whatever reason and becomes a more cascading problem, the stresses which sort of percolate out through the system, and you very, very quickly see problems, and effectively that's going to tighten lending, tighten the economy, tighten financial conditions. You'll see weaker growth, and really the banks won't do well under that environment. If, as we think, that the stresses somewhat cauterised, particularly in Europe, all the liquidity provided and the fact that the banks have very good capital positions, if that is the case and the damage to economic growth is really quite small, then you've still got to fight inflation, in which case I think that rate expectations are a bit low. Both short-term and medium-term, I think rates are going to stay higher for longer because we still have this inflationary problem, and that will be helpful for banks.
Now, we've only got a few minutes before we wrap up, but we've got a poll for you all to take part in a moment. If you can scan that QR code, that's how you take part in this one. It's just to get a view from the audience on what you think inflation is going to do over the next 5 years. And that'll pop up in a minute. But so, yes, Seema, what's your take on the equity side of things?
Exactly the same. I mean, value has to be one of the key factors. You know, after so many years of growth outperforming, last year was a real, I think, a real headache for portfolio managers of trying to accept that actually value could have a longer run than just a couple of months, which I think will become very accustomed to. But yeah, look, if you believe that inflation is going to be higher, then you have to start thinking about value. And, you know, like you're saying, there are going to be important value segments within every single sector. You know, I know everyone's going to hate this term, but this really is where active management is important, because you actually have to know where are the value, what are the specific of those sectors that could withstand some of the additional volatility that we're going to have over the next couple of years. So no, I think there's a wide variation, and I do think energy is a key place. You know, just harking back to your previous question about hyperinflation. Gosh, I mean, energy, commodities, any kind of the geopolitical order really changing. I mean, that is another scenario.
So my last question, and it's always the trickiest one, is 10 years from now, you have to lock up your money in one asset for 10 years. And you're not allowed to touch it during that time. So, and Seema, I'll start with you. Sorry. Whereabouts do you put it?
Okay, so I'm trying to weigh up I know you said I can't say equities. You want something more specific.
A little bit more specific.
A little bit more specific. Okay, so let me forget that then. Let me say anything private credit, private equity. I think, look, there's a very good case to be made that cyclically there's going to be problems in the next year or so. But if you're looking at over the longer term, I think that's where your greatest opportunities are.
Wow, that's really interesting. In fact, the next panel after this one's about private equities. They'll all be pleased to hear that. Sharon?
Maybe I'll go a bit more broad. I mean, I do think equity, and then within that value equity, so maybe some income funds or value funds that have done poorly. A bit to your point that what has structurally not done well in the last few years, and if you think that things are structurally changing, maybe have a look at something which could structurally change and outperform for a period.
Am I allowed to say multi-asset absolute return fund, John?
Yeah.
I mean,
I
feel there might be a mild conflict of interest.
Yes, there might.
So, I'll be a little bit more specific.
Well, that would be the number one choice. But I think actually it comes back to the equity conversation. I would buy a basket of value stocks in all of those chains that I'm interested in. But I should say, we do think there's going to be a recession. If you look at the American market, it's priced for 0% earnings growth. It's on 18 times. You're going to get 15 off that in a typical recession at the end of the year. So opportunity is going to come to you. And that allows me to answer one of the questions that somebody put up about cash. Like, cash gives you a lot of option value. Right? So it's counterintuitive. In the inflationary era, feels painful. But it's a lot less painful if the assets you want to buy fall 30% and you can then snap them up. So make the most of cash. You get paid now some kind of carry for the optionality, and a lot more bodies are going to come to the surface. Long and variable lags and monetary tightening, we are not through that yet.
So actually the answer is a better way. You won't want to sleep for 10 years. Yes, you want to have the money in the cash now, where you're getting a yield, and then use it
like trapdoor spider.
Yeah.
Well, I think that's almost all we get time about. Can we just bring up the results of the poll, see what everyone thought? Now, oh, that's interesting. Okay, so basically, this is, I don't know if you guys agree with this, but I suspect you probably do. So hardly any of you think it's going to be a low target in 5 years. A few optimists think it'll be around target. Most of you are opting for above the 2%, and a significant chunk think that the Bank of England will actually have to raise its target.
3% is the new 2%.
Yeah.
I think it'd be a long time before they raise the target. They're not officially anyway.
I think it'd be too dangerous for them to raise the target in the next year or so.
Yeah, I think the Fed maybe has to do that first. It's hard to move out of line with the big central bank, isn't it?
To be fair, all the central banks have been moving before before the pandemic and the recent sort of upshot in inflation. The central banks have started moving to average inflation targets, so they kind of crept that way anyway.
Yeah, I suppose they pulled back from the brink there, but
You
yeah,
can only do it though once. You can only explicitly do it once you have attained price stability. Otherwise, you completely lose credibility.
Yeah.
Well, that's it. Thanks very much. Thanks very much to Alex, thanks to Sharon, thanks to Seema, and thanks to all you for all your questions. Now, you're now due a coffee break, you lucky things, so you can get out and stretch your legs for about 20 minutes, but make sure you get back in the room, because actually we will be talking about private equity, private markets, which Seema brought up at the end there. And I, for one, I'm very curious actually to find out about that, because at the same time, it seems to be the kind of area where things could go wrong in the next year, but maybe not in a decade.
I mean, 10 years, 10 years.
Yes. So thanks very much. Thanks again to everyone.
From Credit Suisse to crisis. They say all press is positive, but Credit Suisse has had more than its share of bad headlines. Founded in 1856 by industrialist Alfred Escher, the Swiss bank grew to become one of the biggest financial services companies, operating in around 50 countries across the world. It came out of the 2008 financial crisis in a relatively strong position and did not take any government bailouts. In the aftermath, the bank cut jobs as it pivoted away from risky investment banking to focus on wealth management. That brought problems and was soon pulled into a number of cases for assisting tax evasion.
We should have caught it. We should have had managers, we should have had control people who caught the fact that this was happening, but absolutely, they were wantonly violating our policies.
Its global presence brought risks. Raising $2 billion of funding for Mozambique's fishing industry saw Credit Suisse drawn into a wire fraud criminal probe. In March 2019, it emerged that Credit Suisse had hired private investigators to spy on a former employee it suspected of taking its clients.
Our shareholders have been extremely robust. If you look at the share price, it's not the share price of a company in crisis.
2 years later came more problems. The collapse of supply chain financing company Greensill Capital embroiled the bank. Swiss regulator FINMA said it made partly false and overly positive statements when it marketed $10 billion of funds to clients as a safe investment. But soon after came Archegos Capital Management. The collapse of Archegos brought Credit Suisse $5 billion of losses and saw executives fired. It's also found itself the first Swiss bank to receive a criminal conviction tied to a cocaine smuggler. Efforts to reassure investors ran into problems.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That saw FINMA open another investigation when the bank reported those outflows had continued. As the bad news came in, losses mounted and investors became even more wary, including its biggest, the Saudi National Bank.
I'm wondering whether you would be open to assisting further if there was another call for additional liquidity from Credit Suisse.
The answer is absolutely not, for many reasons, outside the simplest reason, which is regulatory and statutory.
And those few words were enough to send Credit Suisse shares diving to an all-time low. Even a $54 billion lifeline from the Swiss National Bank could not erase all the losses. It may have lasted 167 years, but Credit Suisse will be remembered for this one.
Please welcome to the stage Permira Managing Partner Kurt Bjorklund, KKR Partner and Co-Head of European Private Equity Philip Fraser, and Pantheon Ventures Partners and Global Head of Investment Structuring and Strategy Imogen Richards, with Bloomberg's Jan Henrik Forster.
Welcome, everybody. So let's talk private equity now. I don't have to introduce anybody because the voice of God did it already. What I like about this panel is that we have LPs and GPs on it. I think it's a good, a good starting point for a good discussion. I hope you will disagree a lot. Imogen, I would like to start with you. Obviously the whole environment for private equity has changed. Some people say making money for private equity firms has been easy as well for investors. If I had 20 million now, should I still allocate into private equity?
Well, of course you should, Jan Henrik. The private equity industry obviously has experienced a lot of growth over the last 10 years. I think annual distributions are around 23%. That has paused somewhat. So at the end of 2022, that had roughly halved. But I don't think that changes the overall attractiveness of the industry. Fundamentally, we're investing in good companies that are being well managed with significant growth potential. So I think there's a lot of exciting things to invest in the private equity.
Growth, although it's tricky at this stage. I mean, Kurt, you're a big tech investor. If you look basically, if you think about the SVB fallout, right? Like lots of people talked about the mismanagement here of assets and liabilities. But it's also a story of over-concentration to this tech sector. What's your take on that from the tech investor perspective?
So I'll start with a slightly longer perspective, which is that when I joined the industry in 1996, I was warned that it's too late to join the private equity industry because all the good investments have been done and there's too much capital chasing too few deals. That was the story then. And then in 2008, when I was asked together with a partner to take over the leadership of the firm at the time, the story was the same. There was an article written somewhere which said, well, good luck, guys, because the golden era is over and it's going to be really, really tough. And yet we've had the best decade of investing, give or take, behind us. And our industry, at the end of the day, we thrive on a certain level of volatility in the markets. So we can choose when the markets are very strong. We can choose to be sellers and benefit from that environment. And when the markets are full of fear, when the markets are risk-off, and crucially, when there's a need for long-term patient capital that can actually drive different outcomes. That's when private equity comes to the fore and when there's a real role for us. So that's kind of the macro that you're talking about. In terms of tech valuations, so I started my career in the late 90s dot-com boom and then very severe bust. And you could sort of see a redo of a better sequel of all of that through the last 5 years or so, where you had a lot of herd behavior, where anything that you could label as technology suddenly became a so-called unicorn. I always hated the expression. And there was a lot of tidal capital that came into the sector that then drove the valuation environment into a self-referential place. And now we are seeing the reset on that basis in very much the same way that we saw the reset in 2000, 2001, 2, and 3. And that reset it's very discriminating in the sense that it creates, on the one hand, it just shows that some companies were never very good and should never have had access to that much capital. But on the other hand, it also creates some fantastic investment opportunities. Because we know, like if there's a few things you know for sure, and one of them is that over the next 20, 30 years, the onslaught of technology-driven both growth of and creation of profit pools will continue. And if you invest in the right companies, partner up with the right entrepreneurs and the right management teams, and you help that happen.
That said, though,
then you can do really well.
You cannot deny the fact, I mean, obviously you saw the inflation data, rates will continue to rise, and I think it's very clear that financing will be more challenging. KKR is a good example, I think, like when, pandemic kicked off, you deployed a lot of capital. Now, kind of, it's another crisis moment. Philip, what's still possible in terms of deal making at the moment? What do you feel comfortable with?
First of all, thank you for having me on
Always.
this interesting day. We'll see what the Fed does today. A lot of people focus on it. I agree with Kurt. At the end of the day, what we do is being micro investors and long-term investors. We are thriving when everybody else is afraid. It's also true if you remember what Warren Buffett says, when the tide comes out, you see who swims naked. Unfortunately, a lot of people have actually swum naked. And that's not surprising when you had $4 trillion of money printing during COVID, that a lot of exuberance entered the system, and people, as Kurt said, really mistook overall exuberance with a sound investment strategy. What really differentiates you in this market now is first a long-term perspective on the underlying segments. So during COVID, we bought the largest hospital company in France, for instance. People thought we were absolutely crazy. But our healthcare team on a global basis had done a lot of work on the sector. And while nobody had any idea how we got out of this pandemic, whether that's 12 months, 18 months, 36 months, we knew that over 5-7 years it would be fine.
It was binary.
It was binary. And overall, we also have the ability to add to our companies in terms of operational experience. We had owned HCA before, so we knew how to run a hospital company. So there's to your earlier question, what deals can get done? The number, and that's my second point in terms of the overall trends right now. So the first being thematic investing. The second, you want to be able to partner. It is much less likely now that you can convince people to sell you 100% of something, because people will be afraid that that's not a great moment to sell 100% of something, given the turbulence in valuations. But if you can convince them to partner with you while still maintaining a significant share in whatever it is they bring you in on, and participate in the future value creation, and that's a really sound value creation. And we at KKR over the last 15 years, as you know, we have done 3/4 in Europe deals in that category, and are very much convinced that this will now be the category that will be outgrowing others in the next 5 years.
Another trend is clearly that the number of public companies is falling, whereas kind of private markets is growing. That's a clear trend, and also basically institutional investors allocate more to private equity. In terms of deal sourcing, Kurt, how do you feel about public markets now as a source of deals, basically?
We feel very good about that. So of the last, just as a little microcosm, of the last 6 control buyouts that we've done, 3 of them have been public to privates. That's more than trend. That's more than average. We believe that especially in this kind of environment where the public markets are in need of liquidity, sometimes struggling to make sense of all that is changing rapidly, and it's very hard to understand the baseline of how companies are dealing through this period of inflation and volatility, for example. Whereas that's kind of our bread and butter, we have seen a lot of opportunities in the public markets. That doesn't mean that the public markets on average are cheap, but it means that when you look at the bell curve of distribution, there is that tail of companies which we think are incredibly high quality, and where with a long-term strategic ownership mindset, you can drive really good value. So in this kind of environment, what tends to happen is that the public markets correct first, and they correct first without discriminating too much between companies. And then the second thing that happens is that corporates start thinking about their portfolios and either buying or selling. So it can be both an exit environment or an entry environment for us. And then the third thing that happens is that ultimately, at some point, those private equity or financial owners that sit on assets, they sort of rebase their expectations and say, okay, well, maybe this asset is worth a bit less than what I thought it was worth before. So there's a fairly repeating source of opportunities, I think, that comes out, and I totally agree with you, Philip. The kind of partnership opportunity is very high at this point.
We only have one problem. If you think about, I don't know whether you guys know where the S&P 500 was at the onset of COVID. It was actually at 3,200. We had 4,000 this morning. So what has happened since COVID? Has the economy grown? No. Are we in a safer geopolitical situation? No. Have interest rates remained low? No. So how can we justify 20% higher stock markets? So Kurt is right, this will be a really interesting investment strategy, but we haven't seen the end of a significant correction in the stock market, most likely.
But it's also an interesting point around how public market valuations compare to private market valuations.
Correct.
I think we've seen some reductions in tech valuations in the public markets that don't seem to have really followed through yet to private markets. And obviously we've got that lag on valuations, so we're always reporting behind where the public markets are. So it'll be interesting to see how quickly that follows through into private markets, or if indeed it does follow through. I think historically private equity has been much less volatile and much more smoothed, because ultimately we're a long-term investor, so we don't have the same kind of dynamics that you might have in the public market.
From what you see, we have, sorry, Imogen, we have a take on that data. It's not super accurate, but our data would indicate that there's between 18 and up to 36 months of lag between a public market correction and where new private equity investments start happening, which is why just being super patient and stable, keeping an even keel and not staring at the screen, trying to pick the bottom or trying to think that this is too expensive at this point, but just finding great micro investment opportunities that you think you can be a great investor for and keep on deploying through that.
And you've got a very different type of universe in the public markets too than you have in the private market space. You've got much more diversification, many more opportunities in private markets. So actually public market valuations don't necessarily always translate into what those private valuations should be.
And what do you see from your portfolio? Do you feel like returns are also coming down now in private equity funds or in private markets?
Because if we look at the latest valuations, which is Q4, buyouts have actually been pretty flat. So we haven't seen any
as a strategy
buyouts. As a strategy from Q3 to Q4, valuations were pretty flat. Venture has come down a bit. It'd be interesting to see actually what happens as a result of, obviously the SVB fallout has been actually relatively contained, but they have had, they do lend to that venture community. So if that is pulled back at all, it'd be interesting to see if that has an implication on valuations because of companies' cash positions. So I think we may potentially see more valuation falls in the venture space, maybe some in buyouts, but there's no evidence of that so far.
I don't think the book is anywhere near written yet on what the performance of over the last 5 years of different classes of private equity.
I mean, I guess the only thing we know fundamentally, and that's the reason, Kurt, our asset class exists, you have significant moral hazard issues in the public markets. Right? Poor corporate governance, poor performance that is not immediately actioned, with changes in management has led us into this current crisis in the banking world. And, this is a good example where active ownership, like the active ownership represented by our asset class, makes a difference,
How do you feel generally about, I mean, we talked about financing, right? That the one thing is, it's not that financing is not available, it's a cost of it, right? That's the issue. Now you have a situation where Credit Suisse is gone. That was a big leverage finance lender as well. And then SVB, which was very important, as we discussed before, to the private market system. Do you see an impact on that when you look at your portfolio?
So I'll be a bit provocative. I think that lack of financing or the cost of financing is a lame excuse for not investing well in private equity. Because what happens is, so of course, what is really hard to do now is the sort of tailwind kind of investing where you take a low growth profit pool and you leverage it up to the hilt at low cost and you magically conjure higher equity returns out of that. That's sort of LBO 101 from the 1980s. That you can't do in this environment. You, by the way, could do some of that over the last decade. But what you absolutely can do in this environment is you can buy and create high growth profit streams, whether it's in services businesses or healthcare businesses or software businesses, whatever it might be, consumer brands, consumer digital. And what happens is that the pricing corrects. So I would say the journey in this kind of environment is that the volume of total opportunities comes down, but the quality of that opportunity set actually goes up because there's a bit less competition, prices have adjusted down, and the financing markets, they'll be fine. They'll be totally fine. If you take a 5 to 10 year view, they'll be okay. At a different baseline level, I think that the longer term rates that we saw 2 years ago are unlikely to come back anytime soon, so we're not assuming that. But the financing markets will be there.
Where Kurt is right, there's a massive flight to quality and differentiation now. Because if you are not global, if you don't have operating capabilities, or you don't have sector-specific expertise, in this market it's very much more difficult to do deals.
I think there's also going to be a proliferation of other types of capital. So we've seen, obviously, private credit become really important. I think the secondaries market is going to be really interesting. So secondaries where they can support GPs with companies that need additional financing, and maybe if you can't get that as much on the traditional financing markets, I think the secondaries solution could be an interesting one for GPs.
How big is the market by now, secondaries?
I don't know off the top of my head, but it's grown very significantly over the last 5 to 10 years.
But it's still a tiny fraction. I mean, I'll get the exact number wrong, but it's low single-digit percentages of the total. Like, from memory, about 1% of the total AUM under private equity is traded every year in secondaries. And it's actually, you know, our industry, maybe 10 years ago, we used to resist the secondaries market. We somehow thought that it was not good for us. But the reality is it's great that you and others create liquidity for Philip and us for our investors in fund stakes, because that means that that sort of chasm between the public markets where there's ultra high liquidity but also poor transparency, and the private equity markets where we have very good transparency into what we've invested in, and we share that with our investors, and we have direct governance control, but traditionally very poor liquidity. That kind of, our asset class is moving towards having a bit better liquidity, and that's only good for us.
And there's also been an evolution in secondaries. So there's the traditional where you're buying out LP positions, but there's also the GP-led situations where we're providing capital for GPs to support those companies where they really feel like they have belief in those assets and they want to grow them and need additional capital to support that growth.
I mean, the fact is, if 4 trillion of money printing is reversed, liquidity comes at a premium. So any mode of creating liquidity is welcome. And for sure, secondaries is the place to be right now in the market, no doubt.
What about, I mean, is liquidity an issue at all, and also redistributions to investors, because it's hard to exit at the moment? So that's, the whole cascade is a bit disturbed, I guess.
It's a massive issue. It's really, really interesting, right? So 15 out of the 20 largest GPs in the world were raising their private equity flagship funds 2022, 2023. That's unusual. Normally, it's about a third. And like a long term, normally, it's about a third. And at the same time, you have with our LP base, so the traditional sovereigns and state and national pension funds and so forth, they have seen a combination of the so-called denominator effect, your point, exits drying up, some things that could have been foreseeable, or should have been foreseeable, I should say, like subscription lines being drawn in and so forth. But the bottom line of all of that is that there's a pretty meaningful, in the more mature investors in the asset class, there's a pretty meaningful lack of capacity to invest, and then that gets spread over secondaries and primaries and the different kind of the spread of asset classes that we have. So therefore, there's a pullback of the new capital coming in fund commitments, which is great for us, because what that tends to lead to is just less competition. So whereas 2 years ago, everyone was very much on the front foot, the level of competitive aggression was high, that led to higher prices, and the level of financing was high. Now you kind of have all the inverses of that. So you have less competition, number of GPs a bit more on the back foot and distracted by fundraising or other things. The financing markets are not as aggressive, so it's harder to do. You have to come up with a better mousetrap, if you will, to get something done. Valuations are down for a good reason, and just the level of uncertainty is higher. Therefore, the need for longer-term thinking and patience is higher. So you take all of those things together, and unlike what might seem intuitive, this is actually the kind of environment that always historically has created some of the best vintages for private equity investing.
There's even one more point to be cheerful about, in addition to reduction of supply of capital for opportunities, which is the demand for what we do. If we can be value-adding investors, buying add-on acquisitions for our portfolio companies, bringing them international, helping them with the energy transition, helping them with technology transformation, is way up. Because we have never lived in such an uncertain time. We've never lived in such a time of so much rapid change. And the public markets are not really good in coping with change. So if you look at the Axel Springer take private we have done, it's a good example. You know, the family just didn't think that, you know, being public would be a good change agent for them to cope with all of that change. And how do we deal with ChatGPT? How do we deal with, some of the other technology changes? So I think we see more demand for what we do. Where do we find the capital? We'll find the capital. There might be short-term institutional reluctance because of all the things we discussed, but also there we have a massive change now in the fact that the interest for what we do fundamentally is broadening.
I think that fundraising cycle is an interesting topic. First of all, I think we're seeing more flight to quality. So those top GPs are finding it okay to fundraise, but those broader second layer GPs, I think, are going to struggle a bit in the current environment. But to your point, Philip, I think it's a really interesting opportunity actually to broaden the investor base for private markets. So private wealth is obviously a really interesting area of the market that I think is going to see significant growth and interest in our asset class over the next few years.
I mean, obviously returns were good, growth is good, and private equity as an asset class seems to be quite resilient. Although, I mean, I look at the banking sector now. Big banks can blow up. What about private equity funds? Where do you see the weakness?
You know, someone said a very good line the other day, which is that companies die of old age and banks die out of heart attacks. And it's not my line, it's borrowed. But I think private equity falls more into the private equity firms. If they die out of old age as opposed to heart attacks. There's no balance sheet construct that would suddenly blow up a private equity firm. What there is if you systematically perform poorly, your investors, especially in this kind of environment where there is, to your point, a flight to quality, your investors will just say, hey, you know, actually, thank you, but no thank you. And that happens in one fund cycle, and then the next fund cycle, and then the firm is in some kind of run-off mode because all the best talent is gone, and it's the older people that remain in the firm and can't regenerate and recreate the platform anymore. We're an intensely dynamically, constantly shifting asset class and industry. So you have to be very much on your front foot, and you have to be very both willing and able to disrupt how you think about what you do all the time.
I mean, what you're experiencing with the Blackstones, the KKRs, the Apollos is the creation of institutions from first generation founder-led firms. And the genius of these founders was to very much embrace the notion of culture eats strategy for breakfast. So they overinvested for 50 years into culture, nurturing the way KKR, as an example, but the industry as a whole has really nurtured the next generation of leaders is through 20, 25 years of apprenticeship, right? Which, if you compare that with some of the institutions that have gone bust, is very, very different, where there's a lot of lateral hiring and lack of cultural affinity. So I think that gives us a bit of robustness in our industry, quite frankly, because it's almost like the old adage, you can make a mistake on a deal, but as long as you learn from your mistakes and you're encouraged to learn from your mistakes and people very much spend time with you on it, you'll be in a better place for it.
I think we're also evolving as an industry, right? So 20 years ago, most people were just doing buyouts as a main strategy, but now people have expanded their alternative wheelhouse. So they're now doing infrastructure, or they're doing private credit, or they're doing growth strategies. So I think that evolution to continue to grow rather than dying, I think, is an important feature of the industry.
And that seems to be what investors like, right? They go to these private equity firms and can offer multiple strategies, basically from infrastructure to credit. Do you think like those firms who don't have these capabilities will have to consolidate?
Let me start because here's Philip's firm and ours is very different in the strategy we have. We are more in that kind of pure play plus camp. So we have a large private equity firm. We have a credit operation, which has quite a lot of diversity of product, but not as much as you would have. And then we have a growth fund. And you sort of started stating an assumption as a fact, the assumption that
That's how journalist work.
Yes, and I'll just want to unpick that assumption a bit. It depends very much on the cycle. So where you have the pressure of capital coming in, and a large institutional investor says, I just want to write a 2 or 3 billion commitment, where can I put in that capital to work in a diversified strategy? Whereas in this kind of environment, it's exactly the inverse, which is, show me your performance, I want best of breed and best of breed only, and I will only back this product with this firm if it qualifies. So you get one type of environment which is very conducive to growing the platform sale, and then you get another type of environment which tends to weed out the weaker platform plays. And I think we're now in the latter. As a firm, we're debating this a lot because we need to ensure that we build and grow an incredibly successful private partnership-based investing platform with enough capital and, of course, access to the talent that we need, because this is, at the end of the day, it's only a talent game. And so far, the private ownership model has proven to perform better than the public ownership model when measured only by the performance of the flagship products. So far, that's been the case. Like looking back 10 years, who knows what the next 10 years will show.
I mean, Jan-Henrik, maybe I add from KKR's perspective. I mean, I grew up in a firm. When I joined KKR in 2001, I think we were 8 people in Europe and 39 worldwide. And we just had an office in New York, in San Francisco, and in London. Now it's a truly global firm. It has infrastructure, it has real estate, it has credit, you know, it has still private equity. From my perspective, it goes back to the culture point. As long as you can maintain and extend the key parameters of your culture to other segments, and they feel all as one team, you'll be in good shape. What you cannot do as you diversify away from your core business is to allow different cultures to exist. That is always the beginning of the end. I mean, as an anecdote, I remember it was so frustrating when we just had private equity and we had certain opportunities. They were just too small or they were too high growth. We had no homes for it. So it feels like some of the strategies we added, like the growth strategies, were natural. And then in today's age, if you have energy transition, it greatly benefit from being able to go to certain places and say, okay, here's our private equity solution, and here's also our infrastructure solution. We see more and more how we come together. You know, Telecom Italia was one example, and basically go to those firms and offer both.
I think you're touching on the core piece of that, which is really what's the rationale for why someone is doing it. So are they doing it for the right reasons, or are they doing it for asset gathering purposes? I think it's really important to differentiate that.
It's all about leadership and execution in the end. Yeah.
One question to Imogen. If you look at your portfolio, do you feel like firms have sufficiently adjusted their valuations?
I think that what's happened over the last 6 months, because frankly we've been in this environment for a while, that this has been on the horizon. I think what's happened is, whilst public market valuations have come down, so comps have come down for valuation purposes, the companies themselves are actually performing fine or actually doing well. So that's kind of counterbalanced that reduction from the public markets in terms of the multiples that people are using. So it does feel appropriate that the valuations are where they are. And as I said, that's roughly flat. Some companies are doing better than others. I think it'll be interesting to see what happens in Q1. We might see more valuation reductions, but for now, I'm not concerned with where the valuations are.
Conscious of time, 1 minute. One more question to Philip and to Kurt, and be very brief about it. Is the golden era of private equity over, or has it just started?
It has just started because of what Kurt mentioned in terms of the fact that the need for what we do, growth, turbulence, public markets are not good harbinger and transformation agents of that, is way up, but also the demand is way up. In an aging world where people need to generate returns, for people to live decent, retirements, you you cannot just rely on the public market. So the funnel of our investors is going up from institutional investors to private wealth. And the democratization of private equity is ushering in a new golden era for private equity, in my mind.
So the case for private, responsible, long-term, impactful ownership is really strong, whether you look at performance, whether you look at the quality of the businesses that come out through that ownership, or you look at the emerging tools to create liquidity in that market for investors. And the numbers are very large today, but the penetration of the asset class is still actually really, really low if you look at it as a total ownership model, market share, if you will, of the world. There's a long way to go, and I think there's like a fascinating next 10 years ahead of us. And there's a cycle, but that's okay.
Yeah, we are optimists, so let's not mistake that as saying the next 3 months will be easy sailing. It's going to be really turbulent.
We quote you on that. Thanks very much. Thank you so much. It was great. Interrogation over.
Thank you.
Thank you.
Please welcome to the stage Stanhope Capital founder and CEO Daniel Pinto, and Algebris Investments founder and CEO Davide Serra, and with Bloomberg's Francine Lacroix.
Hi, everyone. So we already had a pretty spirited conversation, actually, in the green room. So I could not be more delighted now to bring this conversation on stage. Please, if you have questions, just use the QR code and send as many questions as you want. We talk about asset management. I mean, wow, what a couple of 3 weeks that we've had. I don't know if everyone's, quite gotten to grip to what exactly we've lived through. Davide, where are we in the banking crisis?
I think we are, let's say, whatever has been done over the last 15 years made the system ultra safe. Then 2 policy mistakes were done. Donald Trump increased the regulation of systemically important banks from 50 to 250, and that allowed SVB, and that created all sorts of risk in US regional, so anyone below 250 billion. And secondly, let's say, CS twice lost 5 billion, Archegos and Greensill, but by law could not have had more than 3.5 billion exposure, which was 10% of its equity, and so in a way had 2 massive fatal blows, even from a legal perspective, and that basically knock off confidence. I think though these, in a way, are 2 clear events. They're not systemic because, thanks God, the re-regulation of the system has made that, for example, this could not happen in Europe. In Europe, there are any bank above 10 billion euro is regulated almost like JP Morgan. Yeah? And the reason is because in Europe we had so many small bank failure that the regulator said enough is enough. If you are a bank, it doesn't matter if you're small or large, you need to follow the same systems.
But Daniel, this is a bank run, right? Old school, we don't go to the bank and get cash out anymore, we do it on our mobiles. And this happened for both banks. So is this a crisis of confidence? Is this, people freaking out? Is it silly season? Or was it just that you can't raise interest rates from 1% to 5% without something breaking?
So obviously what you've seen with SVB and Credit Suisse is obvious cases of mismanagement. That's the first level, and I would agree with what was said before, which is that we're not on the verge of a systemic crisis. However, the culprit, if I may say, is the Federal Reserve. Let's be very clear. Taking interest rates from 0 to 4.75 and probably today to 5% over 8 months is irresponsible and was not necessary. Yes, inflation is the primary mission of any central bank. Fighting inflation is the primary mission of any central bank. But the second mandate that the Federal Reserve has is to support the economy. It was very clear that by being a bit more patient, Powell would have given himself a chance to see that inflation was slowing down. As you know, between the time you make the decision to raise interest rates and the impact it has on the economy, it takes a few months. You just need to see it through. They decided to preempt and raise and raise and raise. And now you see the cracks in the system. So in terms of how this banking crisis is going to unfold, I would say it very much depends on what central bankers are going to do in the next few months.
It's an outlier call. I mean, a lot of people say, look, they were behind the curve on every front. If you look at GDP,
they were behind the curve, but then they were ahead of the curve.
Too much. Do you agree with that, Davide, that it's the central bank's fault?
Well, certainly the word temporary that they used in 2020 and 21 was very unfortunate because inflation wasn't temporary. It's obvious now that it's structural for many reasons. Now, I think though in this banking crisis in a way, I would characterize as the banking crisis of the rich. If you think about it, SVB was the bank, Silicon Valley, all the tech guy, startups, and all the venture capitalists. I mean, the average deposit was more than $10 million. I mean, that's not a retail bank. That hit First Republic, which is the bank of a hedge fund manager and the private equity guys in New York. They panicked too. And Credit Suisse was the bank of the global rich. So the funny thing is, this time, the banking crisis happens when banks make bad loans. It's an asset problem. This time, assets are fine. It's a liability problem. And guess what? It's in banks which have, they're not the normal bank. A normal bank has 100 million deposits per branch. Here, Silicon Valley Bank had 10 billion. So in a way, it's institutional run, very concentrated clientele, all billionaires. And they all panicked. They're all on social media. And all of a sudden it says, oh, wow, I don't trust it, just move. But that's not what's going to happen to the rest of the banking system. That's what I want to make it very clear.
So what if you want a safe, sound bank, don't bank to billionaires?
Well, I would say
billionaires
don't go,
that are
sorry,
on social media.
Maybe the question raised is, how smart are these billionaires? Yeah, if they had all the money in 3 banks, so they can have a bank run in 3 days. Maybe they're not that smart.
Daniel, when you go back to central banks, do you think now, if we look at the banking crisis and financial conditions and the possibility of a credit crunch that could be actually around the corner, has it done the job for central banks in terms of raising interest rates?
It has. And the sad thing is that Mr. Powell will probably announce today a raise of 0.25 when, in fact, the impact of this credit crunch, this looming credit crunch, the fallout of the banking crisis, is at least 0.75 or 1% in terms of interest rates if you were to compare the impact in terms of credit contraction. And so, again, if he was not driven by financial dogma, he would say, I have enough on the table to believe that the economy will slow down as a result of a credit crunch, and as a result, I don't raise today. But he will raise.
But financial dogma, I mean, is that coming to question when he's like at 3 or 4% inflation? I mean, it's high at the moment. When you look at 8%
but inflation is coming down. I mean, all the leading indicators are showing to you that the economy is slowly, is slowing down. And it's just a matter of giving the monetary policy time to have impact on the economy without raising constantly. Now, the fallout from the banking crisis, I think, is important because, I agree that we are not on the verge of a massive run on all the banks, but there will be very, very substantial consequences here. A is consolidation. You're going to see a wave of M&A, particularly in the US, but potentially as well in Europe. The second element is I think you're going to see banks specializing and returning to their roots. The Swiss had nothing to do with investment banking. They should not have touched it. They went for it because they saw themselves as global, competing against Goldman and the others. Big mistake. They just don't know this field. They are now going to return to wealth management, deposits, etc. The Americans have a culture in investment banking, will stay in investment banking. The continental banks are commercial banks, the French banks, the Italian banks. They have nothing to do with investment banking, a little less to do with wealth management, but they can be players in wealth management. So what you're going to see in the next few months, I think, is banks returning to their roots and their DNA. There is such a thing as a DNA of a bank.
And what's that DNA look like? Are we going to see more consolidation? We've been waiting for consolidation for over a decade. Is now the time?
Well, listen, in America has happened. Pre-crisis, the top 5 banks had 20% of the earnings in the US pool. Now they're more than 65. And now you're going to see acceleration and consolidation in the regional banks. And certainly, the Fed is going to lower the threshold that has been always 50 billion. Donald Trump in 2019 raised it to 250. That's a big policy mistake. They're going to go lower. Secondly, they're going to apply the same liquidity ratio that Bank of England and the ECB has in Europe, also to the US regionals. In the US, in 2018, they said, hey, you guys are smaller. You can do pretty much whatever you want. Now we've seen what happened. I fully agree with Daniel said on all points. Both on the DNA means your history. Why? It's your client. Yeah. Remember, For example, when Deutsche Bank wanted to compete with Goldman, had a problem. If Deutsche Bank, like now, foster his own clientele, the strongest German corporation and Mittelstand around the world is doing super well. The question is, who are your clients? And as Daniel said, if you're in Switzerland, nobody wants you to compete in New York, an investment bank with Morgan Stanley. You know, they already have Morgan Stanley. It's just.
But do we not need a European champion?
Well, we do have them. The issues in Europe, because of law, you can only have European champions country by country, because you have different calls, you have different, policemen. You can't say, as you know, Europe, we share the currency, we share the commission, but, a mortgage in France is different from a mortgage in Spain and a mortgage in Belgium. So as a bank, you don't really have synergies. What Daniel said then on rates is absolutely right. The unintended consequences of what has happened is the financial conditions have massively tightened. So today, availability of credit is much lower for the simple reason banks need to fund at a much higher cost. And as a result, there will going to be less availability. Secondly, at the same time, the price of that credit is going to be much higher. Now, then let's be clear. When we put money in a bank, that money doesn't go on Mars, it goes in credit, mortgages, and credit cards. And if all of a sudden we all want our money back overnight, well, I'm sorry. That's why a central bank exists. That's why it's there to liquefy the banks. So that's how it works. Banks are nothing else but utility of monetary transmission. And by the way, thanks God we have private banks, because every time, even in autocracy, they went for public banks, they all exploded. In China, look at Russia, everywhere there is now world is understood. You need a private pot of capital to risk so that you allocate credit with someone that is at risk.
I have many questions from, yes, go ahead.
No, if I may add, we are focusing on the banks. Obviously, clients of the banks are as important, if not more important than the banks. And the title of your session today is Strategies for Wealth Creation. The first element for clients is wealth preservation before talking about wealth creation.
Let's try not to lose money.
And wealth preservation, the basic element in wealth preservation is security. And what clients are learning today, when I say clients, it's wealthy clients, it's corporations, it's institutional clients. They are learning that if you don't have basic bank security, there is no point in talking about wealth creation. And so what we are seeing, and in fact we built our business at Stanhope on this premise, the premise is that the best interest of wealthy families and entrepreneurs is to split the value chain between, on the one hand, deposits. You should have your deposits in a range of banks, not one. Banks have tried to sell to their clients the one-stop shop concept, which is give me all your needs and I will handle it under one roof and your life will be simpler. Great danger. Clients, all of them, should split their deposits between several banks. Point two, don't necessarily give wealth management to the very institutions that are handling your assets. You can give it to independent people. Point three, certainly do not give any kind of fiduciary duty like trusteeship or to a financial institution. Choose an independent trustee. And these are lessons that people should have learned post-2008. Many families have not learned these lessons. They are now scrambling to reorganize themselves and are willing and able to split the value chain as I described.
I feel like it's a business pitch, and so I have a question saying, is Stanhope's ambition still to go public?
Without any kind of rush, I think we are growing. We have grown organically. We have grown through acquisitions. We are now, managing about $33 billion across the world. We have 8 offices. We don't need to go public now. We will go public, at the right time. I know it's very unpopular, and I think you had a session about, private equity before, where one of the speakers said public markets are dysfunctional. They are not good for entrepreneurs. The answer is not necessarily private markets. The answer is fix the public markets. There are ways of fixing the public markets. And I think that you can have a management-led, a partnership-led company that goes public, maintains the ethos of a partnership whilst using the public markets for where they are best at.
I have many questions for Davide on being net long or short in your credit opportunities fund and your view on COCOs. But before we get to that, is this a watershed moment for actually asset managers? Does it change opportunities for some of the smaller ones?
Listen, I think over my 17 years career in investing in banks, there have been few events where some financial institution went zero fast. And I think investors need to see, what was, your exposure. For example, we're banking specialists. We were short SVB where we could. I mean, we're 99% long only. But where we can short, we were short equity. And de facto, we had zero Credit Suisse exposure in equity in 81 for more now than 18 months. Now, despite being 6-7% of the index. And I think the advantage of being specialized and bottom up, is that you do your homework. Today, as you know, 60-70% of capital is allocated by machine, computers, and passive. I don't trust it. I want to put my money in it because
Why not?
I'm one by one. And when you are the index, you get the good and the bad. And I'm sorry, it's like entering into a supermarket and buying all the wine rack. I mean, who wants to do that? Yeah, sorry.
Well, depends on the day.
Yeah, but my view is get a Brunello, get a Bordeaux, and I'll leave you the cheap wine. If you have the index, I'm sorry, you get it all. Now, having said so, I'm deeply impressed by the artificial intelligence use of Bloomberg because they can translate my accent and they actually speak better than me. Hence, I'm clearly going to go long Bloomberg AI. I'm impressed. I'll use it to understand what I've said.
I mean, I think we need to give the AI a clap,
sorry,
right?
when I rewatch the replay, it's clearly smarter than me. That's
Daniel, how should investors reallocate in this kind of market?
I think you have to believe that central banks are going to be reasonable, if not today, in the coming months, and that would potentially be the trigger for more positive both equity markets and bond markets. At the point where interest rates stop going up and potentially go down towards the end of the year, early 24, that could potentially give a boost to, or the anticipation of that will give a boost to public equity markets and bond markets. So I wouldn't quite tell you 60-40. You have to be more diversified than just 60-40. But you should keep a good amount of equities in your portfolios, and bonds will probably perform well in the next few months.
David, the 81s or COCOs, are they dead?
absolutely not, the opposite. So think about it. GDP globally, 100 trillion. Banks equity, globally, it's 9 trillion. So if you think about it, 100 GDP, 9 equity. And then there is 3 trillion of so-called capital securities. Yeah? But basically, that's the buffer between your money depositors. Now, pre-crisis, that number, which is now 9 plus 3, so 12 trillion, used to be less than 5. So 15 years of re-regulation has increased capital from 5 trillion to 12 trillion. We love that. It's the buffer. That's why you can sleep at night with your depositor. Now, as a result, I think that buffer of 3 is about to go to 5. That's already in Basel III rules. What happened here is a couple of institutions did not respect Basel III rules. SVB, Silvergate, all these tiny banks were either exposed to crypto or don't have liquidity ratio and didn't filter the bond losses to equity. So they just were outside the rule of the, say, top systemically important financial institution. And in the case of Credit Suisse, they had twice a loss, which should have never been allowed in terms of size. So massive risk management failure. That's Greensill and Archegos. And as a result, then it was too late in a way. And in a way, regulators probably should have intervened back then, because you cannot have a 20 times standard deviation event twice, yeah, and nothing happens. So I think the idea that you have few coordinated incidents, surely accelerated by the fastest interest rates increase in history, after having been a bit asleep at the wheel, yeah, on the temporary 2021, has led to these events. But I don't think the system is unsafe. And I think the space for hybrid capital to protect our deposits, it's higher than ever. Of course, let's say, before you invest in a bond, which has been said, understand what it is. For example, we are one of the largest investors, 81 in the space. It's 7% of the index. We had de facto zero. Yeah.
Because you read the fine print in the prospectus?
No, the prospectus is always bad. That's a regulation. Yeah? But the issue is not the prospectus, is the institution. Forget the print. You can't invest looking at document. If not, artificial intelligence will be able to make money. I mean, they can translate perfectly, but don't give money to your computer. if you want to preserve your wealth, let's say. I'd rather give it to Daniel, let's say.
You use AI, Daniel. How do you use AI, actually?
Not yet, but we are thinking about potentially challenging our decisions with AI. So not AI as a driver for trading, but AI as a kind of inspiration, if you will, or sanity check to make sure that what you decide is potentially relevant.
How do you see actually rules and regulation changing, if at all, for asset managers on the back of these crises?
Well, you are going to see, I mean, there was a range of things happening in London before this banking crisis, showing that public markets have issues that need to be dealt with. And I think this crisis will probably accelerate the desire to reform and make our market more competitive in London and elsewhere in Europe. Certainly in the world of banking, in the US, they will return to the pre-2018 rules, I think, lowering the bar in terms of checking or imposing regulation to banks that may be smaller but need to be stress tested as often as the big banks. So I think that's an example of the kind of rules you will see. I would agree with what David has said, which is that Europe has a much stricter regulatory framework, does not necessarily need to evolve. I think we have what it takes to make sure that our institutions are safe. The US had gone astray in 2018.
When you look at the big themes, certainly 12 months ago, actually 15 months ago, let's say, pre-war in Ukraine, it was ESG, it was climate, it was central banks and what they do, but it's all this geopolitics, maybe the end of globalization, or certainly the rethinking of capitalism. Does that still stand?
Look, we have debated about rethinking capitalism for the last 3 or 4 decades. Every time there is a crisis, you say, we have to change the system. And I think to a degree we changed the system in 2008, and capitalism has to be improved all the time. I think you need to put barriers to ensure that greed does not damage the public. But we have no other system, and I think that capitalism works. We just need to improve it.
Davide, on ESG, I mean, how do you look at ESG?
Well, listen, green transition, it's driven by scientists. We are cooking the planet. And hence, now, if you had asked me 50 years ago, does CO2 pollute? I think no one would have understood it. The fact that CO2, which, is the most basic product, of boiling water almost, the fact that then in the atmosphere cooks the planet, it's something that we need to deal. We have no choice. So I think on green transition, there's no time, yeah? And you'll see the consequences because, no one can last. You can last without a bank and without a bank billionaires. You cannot last without clean water. And clean water is going to become, a scarce resource. Hence, I think green transition is global and will keep on accelerating. Before we heard on the electrification of the planet, and is going ahead. I think then, if I look at some of the S&G, it's interesting, like SVB had a AAA rating by rating agency. I always says, if you want to preserve wealth, don't listen to rating agency. That's number one. Secondly, on the S&G, which I think is interesting, was the champion on S&G. Its board was the most diverse ever. No one ever done banking, yeah, and didn't understood that if you take daily deposits, you cannot invest in 10-year treasury. But that's a small print. And as a result, I would say that in the E, the green transition is crucial, and in anything else, it's key also to put the word C, competence, which I think some of ESG people have forgotten.
But you can be ESG and understand bonds, right?
Sorry?
When you can be ESG friendly and understand bonds. It's not because you only focus on ESG that you misprice your bonds.
Of course, but the issue is some of the Taliban lost the word competence. And I think for example, in Europe and in the UK, if you want to be a board member, you need to be interviewed by the central bank. You need to know your stuff. If not, you cannot be appointed on a board. In the US, this doesn't happen. The CEO of Silicon Valley Bank was on the board of the San Francisco Bank, which is its own regulator. I mean, this is Burundi stuff, yeah? I mean, so I think, hence, the word competence matters too. And if we keep on delegating someone else's decision, yeah, then clearly, then you have this failure. So I think, in my view, green transition, key, social and gender diversity, key, with competence somewhere in the mix.
It's crazy that you have to say that, but yes.
Well, in the
Daniel?
S&P case, it's obvious.
No, I mean, I would agree that ESG too often has become a box-ticking exercise. Firms do what they need to do, particularly listed firms, do what they need to do, but without thinking deeply about what they are doing. And I think that ESG should come with a degree of in-depth analysis of what it means to be compliant with E, S, and G, not just ticking a box. And competence is absolutely at the core of everything a firm should be doing.
Let me give you a quick example. In Tanzania, we have already planted 190,000 trees. We buy land, we plant trees. We don't sell any carbon credit. We give back oxygen to the planet. And then a couple of companies told me, oh, we would love to partner up. I said, surely, I mean, just help her out. You know, we have 700 farmers and, you know, we buy land and plant trees with communities. He says, but you need a certification. Then someone showed up and says, $50,000 and you have your certificate. And says, sorry, I mean, we're just planting trees, the 7-8 trees we have in Tanzania. Says, yeah, but don't worry, we can tell you how much CO2 is going to come out of it. Well, you know, and this is what you need. So I think the industry is very quick at creating the so-called label, tick the box, and make money out of it. I think society and capital needs to work, needs the you man up, you take your own responsibility, you're auto-certified, that has to be true. Because if you keep on delegating to someone else your decision, you're not preserving wealth, that's for sure.
Okay, in 1 minute each, I'm going to give you £100,000, or maybe a million. 100,000, I'm cheap. 100,000, where do you invest today, Davide?
For me, fixed income. I think terminal rates have peaked. High quality credit, including the safest financial institution in the world, are a buy today.
Okay,
10 to 12% in dollar.
£100,000, Daniel?
Not just fixed income, a portion in fixed income, and in equities, be ready to return to growth. I mean, I know that when I say that, I'm recommending doing exactly the opposite of what most people have been doing for the last year, fleeing from growth. Growth will return with a vengeance, i.e. technology, etc. They are restructuring themselves. They will, you know, become even more profitable in the future. With interest rates peaking and potentially going down, and with the economy slowing down, the cyclical sectors will not do very well, and technology will do better.
Wonderful. Thank you so much for a spirited conversation, Davide Serra and Daniel Pinto.
Thank you.
The message from Wall Street: expect an uneven year in trading. A much anticipated global recession is likely going to finally land, making it hard for financial markets to rebound from a punishing 2022. So one way to navigate the volatility: income investing, which involves building a portfolio that gives you a regular paycheck. Your holdings may consist of dividend-paying stocks, bonds, and interest payments, as well as hard assets like real estate. The goal is to buy and hold, creating an income stream that doesn't depend on a bull market to produce consistent returns. And here's where the concept of compound interest becomes important. As stock prices fall, dividend yields rise. That enables investors to generate more income from reinvesting dividends at higher yields and making new investments. You can even put your idle cash to work to generate more income. In this way, you can accelerate your passive income goals in a down market. But just as there are upsides to income investing, there are downsides, like inflation. If your income is steady but the cost of living increases, that will reduce your purchasing power over time. And there's the risk that a prolonged downturn leads companies to cut dividend payouts, which means your income could take a hit.
Please welcome to the stage eToro US CEO Lule Demmissie, IG Group Global CEO June Felix, Interactive Investor Head of Investment Victoria Scholar, with Bloomberg's Christine Aquino.
All right. Thank you so much, everyone, for joining us today at Bloomberg Invest. Again, my name is Christine Aquino, and I'm the managing editor for Markets Today, which is our live online platform for the best that Bloomberg has to offer when it comes to news and analysis on everything that's moving markets. And as you know, we're going to be talking about the rise and fall of retail investors. So let me just emphasize why our panelists today are the best people to be talking about this. June, as we know, is of course the global CEO of IG Group, which is the world's leading provider for CFD trading, and also a platform that allows clients access to 19,000 financial markets globally. Lule is U.S. CEO of eToro, which is a social trading platform and features more than 3,000 assets and 30 million users. And of course, Victoria, head of investment at Interactive Investor, which is the UK's biggest flat fee investing platform. So stellar panelists today, hopefully a stellar panel as well. So I'm going to begin with a question for all of you that I'm also going to be asking our audience. So this is my poll question for today, if we want to bring that up, which is basically, what is the biggest challenge that you think retail investors will face heading into 2023? It's a big year, it's a difficult year after an already difficult previous year. So what are your thoughts? June, let's start with you.
Yeah, so I think one of the biggest challenges is trying to figure out how to navigate, get the right information that it gives them the insights to diversify their platform. As was said earlier, we basically have 19,000 markets, which include gold, commodities, oil. So being able to pivot in this market is vitally important, and getting the information that allows them to make that possible and understand their risks is what we do.
All right, and Lule, what about you?
I think, last year was the shock and awe year for a lot of retail investors. So our platform has primarily millennial and young Xer investors, and it's a social platform, and so there's dialogue that happens on our platform, and it wasn't a generation that had seen this depth of a transition, so it's a shock and awe year. I think the challenge now is just steeling themselves to understanding as that medicine makes itself through the system, its side effects, right? We just saw recently, part of it was interest rates and how banks balance their balance sheets because of that. And so I think just having the resiliency, the continued resiliency they've already shown to see the medicine as it works its way through both our economy and our politics.
And Victoria, what about you?
I think during the pandemic, there was almost a sense of euphoria with this huge market rebound. And then after Pfizer Day, that continued to push markets higher. We had the tech boom, which propelled a lot of asset prices to record highs. And now we're entering into this age of uncertainty. There are so many different factors to navigate, from the war in Ukraine to rising inflation, and now, of course, the potential for a banking crisis as well. And I think on top of that, there's the added complication that cash is a lot less attractive now because of the inflation backdrop, which essentially means you're losing if you're not investing. So that can add to pressure on investors to try to find solutions. So I think it's essentially navigating all of these different competing pressures.
All right, well, let's pull up the poll results now and see what our viewers are thinking. What is the biggest challenge? Looks like it's a bit of a tie, actually, between picking recession-proof assets and getting inflation right. So it seems like inflation, recession, certainly big themes for 2023, and there's a lot of tension over what's going to win out over there, what's going to be the dominant theme. So, all right, well, Victoria, let's move on to you then and kind of dig more into some of the things that you've observed this year. Again, as you mentioned, it's a challenging year, already a challenging year previously, and even more so, it's unprecedented times for retail investors. What have been one or two trends that you've noticed emerging in terms of investing styles or preferences at the moment?
Yeah, well, when times are tough, we tend to see that investors move away from active funds towards more passive investments, and that's certainly been something that we've seen this year. We've also been seeing our investors move more towards global assets, so looking beyond the UK borders, particularly towards the US, actually. That's in terms of investment trusts and funds. Then on the single stock side, we continue to see the FTSE 100 dominate. We are a UK platform, and FTSE heavyweights like Lloyds and Barclays and BP and Shell are continuing to be among the most popular stocks on our platform. There was an interesting outlier, which was Argo Blockchain, which has made it into our top bought list in the last 2 months. And that's essentially because it's a proxy play on the crypto rebound this year. Obviously, Bitcoin has been has done extremely well amid the backdrop of volatility. And whilst you can't trade crypto on our platform, you can trade stocks that are linked to crypto. So Argo Blockchain is one, Coinbase is another one. So yeah, quite a diverse mix, but sort of more of a broad geographical spread, and then that shift towards more passive investment products like ETFs, for example.
Yeah, June, I saw you nodding a lot in agreement when Victoria was mentioning just diversifying assets. I know you're a big fan of this investing thesis, classic thesis, but maybe not something that retail investors see as important. But how important has it become now? And do you think retail investors are realizing this more?
Yes, you know, the evidence in our platform, and you have to think about who our clients are. Our clients are usually very active traders and investors. They're quite sophisticated, whether it's on the Tasty Trade platform in the United States. They're moving from options into futures. Not only are they active equity investors, they're trading options as well as futures. And there we see on that particular platform that they're moving more away from single stocks into more index-linked opportunities, as well as looking globally, where we operate in about 21 countries. What we're seeing there, because the breadth of what our traders can take advantage of, we also see movements into gold, we see movements into oil, taking advantage of the fact that oil is priced at like $69.50 this morning. So there is volatility in the market. They're very confident individuals, so they move across asset classes very nimbly. And that is kind of the key right now, is to stay light on your feet, because no one can predict the peak of the interest rates. So having the ability to pivot quickly is part of the challenge.
All right. Well, now I want to pull up the Markets Today platform, because we're very much talking about anything that markets are buzzing about today in the last few days. And I know that, of course, it's going to be all about this mini banking crisis that we're facing, and really the question over what policymakers should prioritize. Is it financial stability, or is it really tackling that inflation issue? You know, Lule, we've seen really quite a lot of turmoil in markets over the last week or so with the downfall of Credit Suisse and, of course, the 3 U.S. banks. What do you think this has done in terms of investors' faith in traditional institutions, especially investors who are just your everyday people? You know, they're not experts or anything.
You know, it's interesting because we have the benefit of both surveying our investors every quarter, but we also see their behavior in terms of what they buy and sell and hold. And so the vantage point of our customer base is, as I said, it's a younger, longer time horizon customer base. We have over 30 million sort of followers in our system. We have crypto, stocks, options on our platform in the US. And so there's an element of sort of like above all of the above that they're doing. So the one thing you do see is they're not getting scared. So still 67% still say they're going to hold most of their assets. They're not going to sell on the low. But the other thing they're doing is when you see their behavior, so the day the bank crisis started peeking its head, you saw options activity rise, crypto rise. I mean, just for perspective on your crypto point, year to date, Bitcoin, I think, is up 67%. Right? So again, I think what's happening is gone are the days where people are thinking to themselves, save me, Papa or Mama, I'm going this way or the other. They're just saying it's both about institutions doing their part and maturing a decentralized system. It's all of the above. It's both about investing for the long run when it comes to diversified instruments like ETFs perhaps, as well as engaging in options which allow you to shorten your durations, reduce your risk, but take opportunity in different market environments. So there's this ambidextrous nature that's happening even in unsophisticated investor markets. So for instance, in our space, even individuals who say, I'm newer to investing, have a higher appetite for risk. So it's a very different dynamic than when I was an executive in 2008, for example, where people were really sort of sheltering themselves. And I think that the resiliency of sort of making sure that they're keeping cash on the side because they want to be opportunistic, but doing this sort of, as I said, this ambidextrous sort of diversify and anchor, opportunity, opportunity, opportunity. It's coming. We're seeing it in their behavior as well as in their surveys.
Yeah, but of course, the adoption of these less traditional assets and markets very much tied with the regulation, right? That has been allowing, well, investors to kind of setting the parameters of what they can or can't do at the moment in the space. June, I know you have some thoughts on this. You know, what do you think about the amount of regulation that we're seeing now in markets in general, really, but perhaps also in less traditional markets? And you know, do you think it's enough? Do you think it's too much? What are your thoughts?
Well, I think it's a very broad question because if you look at by asset class, currently, obviously, crypto is under the scrutiny in terms of not just the U.S. but on a global basis, to figure out what's the proportionate level of regulation necessary. Markets like in Japan, it's perfectly possible. Switzerland, the same. The U.S. is taking a harder look. So it's going to be market by market. I think that each regulator is going to take a stance on that. What we're seeing in the United States in general historically has always been a market-friendly environment in terms of regulation, which has created the largest financial market in the world, and that actually has enabled retail investors to really participate. I think what is interesting is that that's also being looked at on a European basis to see to what extent there could be new regulations that encourage retail investors, whether that's the Edinburgh reform that has just been announced. Those are all stimulating or actually asking the question of how you create broader financial markets. So clearly after 2008, huge onslaught of regulation. All of us have, in financial services, have experienced that. The question is what's proportionate. And I think countries are looking at, on an individual basis, what's going to make them the most viable place for retail investors to thrive. Fundamentally, defined benefit programs are, diminishing, being demolished on a global basis. And as a result, that's why retail investors are becoming much more self-directed, even in low market activity like we saw last year, relatively speaking. We saw a 50% increase in all the content that we create for our clients because there's a hunger and an interest in taking control of your own financial destiny.
All right. Well, you all have touched on kind of just the growth of the retail investor base, both in terms of the numbers, but also in terms of the level of sophistication that we've seen, right? And I want to touch on this idea of this traditional divide between the so-called smart money investors, which a lot of you in the audience are at the moment, and what retail investors have been termed as the dumb money. So, Victoria, do you think this gap still exists? How much is that closed? And what do you think has contributed to that narrowing gap, if it has narrowed?
Yeah, I think this gap has massively narrowed. There's been a huge onslaught of available information online. There's so many resources out there to help with financial education. Apps like Interactive Investor and IG and eToro are very, very easy to use, investor friendly, and it's become cheaper to invest as well. So we've really been focusing on trying to democratize finance and provide access to more and more retail investors. We've also got certain rated lists like our Super 60 and Ace 40 lists, which can kind of guide you towards different investment products, spark different ideas, and kind of get you on the right track. I think there is one area where retail investors are still sort of get the sloppy seconds, which is IPOs, and that's something that we've been doing a lot of lobbying on. There's the digitization task force that's coming out in spring. It's been looking at ways to try to get more retail investors access to IPOs. This is still an area where retail investors don't have equal access. So I think the gap has been narrowing very significantly, but there are still some gaps to plug.
Okay. Now, June and Lule, I'm curious, for your respective platforms, what sort of specific ways have you seen investors try to raise the level of sophistication in their investing? Maybe Lule, we can start with you.
So several ways. So one is, as I said, they're partaking in pretty sophisticated instruments like options in understanding how to hedge their bets, how to take advantage of volatility and implied and so I think those things are definitely, we're seeing it, and we're seeing an adoption of that. And just for context, I think options contracts reached their highest levels the week of the bank crisis, and investors that were in retail were a big part of that, right? So we're seeing adoption of instruments that require more sophistication to partake in, but also they're appreciating that it is not this absolute of risk and non-risk. It's about how do you dimensionalize the risk? How do you make it smaller and frequent, right? Which is the whole thesis of becoming more resilient to risk, right? So we're definitely seeing that. We have not seen them, we have seen them hold their crypto for the most part. And as I said, when they see volatility, when they see opportunity coming into it, and then they're holding these traditional asset classes like equities and ETFs. I would say, our platform is essentially, social investing and the wisdom of the crowd on our platform is the feature, not the bug, right? And so ultimately what happens is people are coming to these town squares to share interesting insights. There are what we call popular investors that people track. And one of our popular investors has over 1 million followers on our platform, for example. So we have mechanisms for people to copy strategies if they want to. But then we also put mitigants like, making sure that there are risk mitigants around this structure, right? And so what's happening, in my opinion, whether it's fractional shares, which we have on our platform, or different kinds of instruments in a multi-asset platform, what's happening is access, lower costs, they're commission-free, that is, right? And then the proliferation of the voice, if you will, the wisdom of the crowd. I think, you were saying dumb money. I want to put a T-shirt that says dumb money because dumb money is the other way around now. And I think that, you can't look at history through the point in time that you're living in. You have to look at it through the secular trends you're living through. And that secular trend is not going to change. Decentralization is here to stay. And the access of individuals to institutional things that were not available to them is going to continue. And I think those are secular trends that will take place again and will have momentum once we get past this environment that we're in.
What about you, June?
Yeah, well, I would agree as well, but in terms of playing a role in terms of democratizing investing from institutional to retail, we specifically offer institutional quality risk analytic tools to our active traders, to our clients overall. So whether it's on the Tasty Trade platform, we have leading edge technologies in order for them to understand their portfolios and also understand their risks on option strategies, and very complex ones as well as simple ones. We create boot camps for people so that they actually get the chance to learn from experts. I mean, most of our people that are actually engaging with clients in terms of answering questions have over 20 years of experience in options trading. So you have experts that have really faced all sorts of fires over time and can provide perspectives and insights on what's happening in the market. We have 7 days a week live programming on activities in the market so that people can hear what's possible and take their own view on that. As well as in our OTC derivatives platform, we provide risk analytics tools so you understand your win-loss ratio, you understand your P&L, you actually understand how your trading patterns and trading practices actually are putting you in a good or bad position. So we're taking a lot of the institutional know-how created by many of the people that created the company and also are in the company, and making that accessible and understandable by retail investors across the globe.
Yeah. Well, all of you very much touched on the importance of information, right, and having access to it, democratizing it. So this brings us very nicely to another topic that's very relevant for retail investors, which is, of course, again, finding that information and arming themselves with as much knowledge as possible so they can trade in the best way that they can. And it's very interesting because this has been a space where, June, as you mentioned, traditionally has been dominated by more established players, right? Like institutions that do offer that access even to retail investors. But I think more recently, we've also seen the rise of social media finfluencers, some of them very dubious, but very popular still, and offering maybe questionable advice on what to do on your own trading platform. So, I mean, Victoria, I know that you're looking at this trend. You're very much kind of a fan of encouraging people to think long-term. How do you think this kind of noise that has emerged from social media complicates things?
Yeah, well, I think obviously social media is incredibly important, and there is amazing information out there. You can follow professional investors. There are so many different companies or resources of information that are out there on social media. So we certainly can't disregard social media is the first thing. It is the future. But there are a lot of, like you say, dubious accounts on social media, a lot of kind of get-rich-quick schemes, and lots of things that look too good to be true. So I think it's really important to proceed with caution, and always do your due diligence. Don't kind of follow someone blindly into a trade recommendation. I mean, you should never really do that anyway. You should always be doing your own research on top of following other people and seeing what everyone else is doing. The FCA has been looking into this and potential regulation. It's already been clamping down on some buy now, pay later services, and we know that they're keeping an eye on investment advice on social media, because at the moment you don't have to be a actual official advisor to be putting out videos there which are, you know, not going to be necessarily accurate. So I think the regulatory environment is going to evolve over time, something that the regulator in the UK is already looking at. But there's no point kind of disregarding social media altogether. It's just you need to be a bit cautious when you're navigating the world of social media. Like, not just in finance, but, you know, in any form of social media, there's kind of the good side and the bad side. So as long as you're kind of mindful going into it, and don't be too swayed by one person's opinion when you don't necessarily know if they have a good reputation. So yeah.
Yeah, June, I know you have thoughts on this as well. Pros and cons? Should they avoid it altogether?
Well, no, you know, you can't avoid social media. I think it's important that, you know, the good news about it is it actually has created a lot of interest from people and made, you know, investing a topic that, you know, millions of people talk about and are interested and engaged in the market. So I think there's a positive to, again, people having to take responsibility for their own financial future. So that is excellent. I think also what's encouraging is that increasingly there are people in the investment industry at different levels have actually sought that channel and promoted their voice through it. So the responsible players that are in it can be wildly influential and highly important to helping people navigate and improve their understanding of markets. But to the same point that Victoria said, you know, it can't be the only thing. It can't be a diet of only social media. Social media by itself, without some of the discipline and rigorous analysis on your own, really can make sure that people fall afoul. We heard that in previous panels. A lot of independent analysis is needed. What we see from our clients is that they actually ingest lots of different media. They spend 2.5+ hours a day really studying markets, trying to understand through, you know, all sorts of channels, Bloomberg, ourselves, you know, any kind of publication. They're not just tuning into Twitter and or the social media platform, and they are discriminating as to who they actually put credence on. So I think used appropriately can be very, very powerful. It can also be very timely, and in rapidly moving markets, that can be a good, very, very valuable.
Can I add to that as well?
Absolutely.
So one of the reasons we felt so strongly about bringing it back into our walls and not letting it be the wilderness people have to navigate is then you can actually then figure out how to manage the moral hazards, right? Which is what we're talking about here. So for instance, on our platform, in order to partake, you have to show your strategy and your holdings. Not personal information about yourself, but you cannot easily, somebody will easily be able to audit what you say, what you're holding, right? The other thing is you have to be a public figure on our platform. You have to actually be, you know, on a public setting to be able to partake. So there's certain things that I think when you put these sort of guardrails around, you get the best of this element and you guard against the moral hazards of it. And there are plenty of moral hazards to guard. I do think, though, figuring out how research, the way we have our research on our platform, the way you invest, and then figuring out how to turn that into dialogue is something people hunger for. Our surveys show us 80% of them want to be able to see other people's strategies and copy it. 70% of them want to be able to have dialogue in this public square. So they're hungering for it. So I think it's our responsibility to figure out how do we manage the moral hazards while untapping its powers.
Yeah, well, a follow-up to you then, Lule, because I know there's also this, and we've talked about the importance of guardrails and really protecting investors on your platform so they don't stray from more questionable sources of information. But what about the entertainment value of the information that you provide? Is that something that has kind of increased in terms of the importance to get the message through to investors?
I mean, I don't know if anybody has kids in this room, but there's nothing I can teach my children without making the education more entertaining. I don't think just because we become adults, suddenly we want to be bored when we learn. So we do employ elements of joy and fun in the education elements of it. And a lot of our folks who are in our content and creation team are actually very right-brain thinkers. It's actually really important to make sure that you have right-brain thinkers on your staff who are thinking through how does a message get through. And so I do think it's important to make it palatable and interesting, and not necessarily to trap people, but because you want to make sure that the lesson is heard. So I joyously embrace it.
Great. Well, all right, so we have some questions from the audience, actually. So this would be a good time for us to talk about this. Interesting questions you can see here. A question about the gender mix of your various investor bases, and talking about how to encourage more female participation. We were talking about this in the green rooms. I know all of you have thoughts. June, maybe we can start with you.
Yeah, so in terms of our investor base, sadly it's not as diverse or as proportionate as we would like. So we're talking about maybe 20% of all of our clients are women. And what we see is in Asia that's a higher percentage than in Europe and even in the United States. So what's interesting about that is that there's lots of headroom, lots of upside in terms of women getting involved, getting interested, because 50% of the population still need to take care of themselves and have to have a viable strategy in order to have retirement and have what I call financial freedom. And just putting your money in the bank is not going to get you there. So I think there's a huge amount of upside. In terms of encouraging women to participate, I think the fact that we're all women shows that women aren't afraid of investing and trading, and they have the analytics and the capabilities to learn just like everybody else. Sometimes it's a question of confidence, and confidence, as we heard in an earlier panel, really does affect the financial markets. So confidence as individuals to feel like you actually have insights, have understanding, have done, have the tools at your disposal, and have the assistance and support will help, women as well as all investors perform better, but also participate, more actively.
Lule, what about you?
Yeah, I think, part of it is representation. I remember we were about 20% women as well, and increasing each time, but 20% women. And part of it is representation. Okay, when you see people, and you're like, oh, they're in that as well, and that makes a difference. And then part of it is also what that representation comes a voice that brings in, okay, how do we access the ears of different kinds of people? So I'll give you an example. For the longest time in our industry, it's about women are risk averse. That is the statement that defines why they're not in investing, and I take issue with that. I am not risk averse. What I do is I take risk, I make it smaller, and I do it more frequently. So it's turning the language into the invitation of how people think about risk, right? The second is the practice before you start, right? So we have an award-winning investing platform, so you can actually do almost everything on our platform that you'd like without actually putting capital at risk. And that's another thing we know that appeals to women, is sort of like the practice before I start running and leaping. So I think one is representation. The other is that representation then leads to the design of the products and the language in a way that's going to be heard by those people. And I think that will change. It's important that it has to. There is no wealth building without people partaking in the markets. None. And so I think it is an imperative that we bring people in.
Yeah, more equal participation, definitely the key here. Victoria, what do you think?
Yeah, I just echo what's already been said by June and Lule about confidence. And also I think it's easy to make generalizations about men versus women and risk-taking. We recently did a private investor survey which looked at the performance of all our customers on our platform over the last 3 years. And what was really interesting was actually women outperformed men across all time periods, not by a huge amount, but it was just interesting that across every period measured between 3 years all the way down to 1 month, women actually outperformed men. So this is something that we're trying to talk about as much as possible, because trying to increase representation, like you said, and also just try to encourage more women to invest more, because there's just no reason why the numbers can't sort of balance out within the years to come, and that's something that we're really, really targeting.
All right. I have many, many more questions, but unfortunately we have run out of time. So thank you so much to all of our panelists for some very insightful comments today. I do leave you with good news. It is now time for lunch. So please make your way out to just outside of the conference room. Thank you very much.